If you want to invest in the stock market or you just want to learn about the stock market and you have limited prior experience, then this video is for you. I'm going to break down over the next hour or so really everything you need to know if you want to start investing in the stock market. I think this is a really important video and one I've been looking forward to making because if you look over the last, say, 100 years, just in terms of wealth generation, the stock market is pretty much, apart from real estate and home ownership, the number one creator of millionaires and wealthy people, right? And at its core, investing is such an impactful and important thing. And in terms of really accelerating the financial opportunities available to you, making more money and retiring with money and being financially free, right? Nearly everyone is going to do that through the stock market if they are going to get there. So that's why I think this is such an important video. And again, if that's you, then stick around. So if we look at what this video is going to consist of with regard to just a general transfer of information about stocks and the stock market and how you can actually go and invest today, right? We're going to start off with why investing. Like, hey, you've heard a lot about the stock market and stocks, but why is it actually important? And why is it important for you right now, right, to create an account and go start investing? Then we're going to get into terms. That's just, hey, what is a stock? What is the stock market? What are dividends? And all these terms you've probably heard a lot about. And then we're going to cover, well, the types of investments, right? Because there are multiple types of investments within the stock market. It's not just you go and you buy a stock or you sell a stock, right? There's a lot more there to cover. Then we're going to get into types of stocks, right? So how to analyze and how to look at and choose and figure out which stocks are good investments and which stocks are not good investments. Then we're going to get into fundamentals. So this is, well, you've chosen a stock, right? You think this stock could be good. What are the fundamental metrics? What are the key things to look at when it comes to figuring out whether that's a good stock, right? The fundamental metrics that drive its business. Then we're going to look at earnings, and we'll get into what earnings are, but that's important because that gives you more information about how a business is doing. Then finally, we're going to get into rules and tips. These are just the strategies, right? The practices, the actually on the ground, how do I go and invest? What shouldn't I do? What should I do? And so on. Then finally, we're going to get into, well, you know, you've watched this whole video, you want to invest, maybe you've been wanting to you've wanted to invest for a long time. How do you open an account right now and go, say, buy a stock? And then at the end, we're going to wrap up with some resources. That's just stocks, podcasts, websites, videos, books, and so on that are great for you to go check out so you can learn a lot more. So that's the video. Let's get into it right now. So again, it really would be wrong to start this video off in any other way than why is investing actually important? Why should you go and invest today, right? And you know, we all know a lot about investing. We've probably heard various different things like, oh, it's a bull market. Oh, the federal government, right, did something with the stock market or the federal funds, or they crashed the market, or there is a market crash, right? Or the S&P reached an all-time high. Like, these are all things that we hear. But I think from an individual perspective, we have to think about why should you actually invest? And that comes down to, well, can you make money from it, right? Investing is about growing your money. And I want to show you why investing will make you so much more money versus if you don't, right? First off, if we think about, say, a job, right, where you go and, you know, you work for your money and then you spend part of it and maybe you save from some of it, right? Your earnings are going to look like this, or your savings, right? So let's say, you know, you work for a week and you make your $800. Of that $800, you spend $600, right? And then you're left with $200, right? So that $200 is the amount of money that you save, that you use on, you know, luxury, like say traveling or going to the movies or nice food or so on. If you make money like this and you spend money like this, your wealth will go like this over time, right? And that's great, right, versus not having money. The problem with this is if you make your, say, $200 a week, you have to spend a lot of that money, right? And then this $200, if you save it, that's just sitting in a bank account and a checking account. It's not working for you. It's not making more money. So if you save, say, $200 a week, you're saving, what, $800 a month? You're saving $9,600 a year. Over 50 years, right, you're going to save a few $100,000. And that's fantastic as well. The problem is that we're living in this time when A, inflation is high, especially over the last few years, and then B, it costs a lot of money to retire. You're seeing that in the US, you're seeing that around the world as a whole, right? So again, most people make, right, they save maybe $200 a week, and that's good, right? And you save a few $100,000 if you do that over the course of a lifetime. And this translates into other countries and currencies as well. But the number you need to retire right now in the US and a lot of places is about $3 million, right? Let's assume at the very least you need, say, 1 million, right? To make $1 million linearly, like, hey, you know, you work a week, you make money, you work a week, you make some more money, and so on, that gets difficult. Because if you're saving $100, $200 you know, even $1,000 a week, right? That's not really going to add up to that $1 to $3 million range over time. And again, the same applies in every country around the world. So rather, what millions of people have done, right, over the past few hundred years is they have let people and individuals make money from companies doing well, from the overall economy doing well, right? And that is the stock market. And the reason that's so powerful is because of the law of compound interest or compound growth. And I've covered this in other videos, so if you watch those, just skip forward a minute or so. But compound growth looks like this, right? This is your money working for you. And if you save that same $200 a week, right, and you start when you're 20 years old, and you put that into stocks, right, versus saving it, if you invest it versus just, keep it in cash or put it in a checking account, right, by the time you're 50 and 60, that's going to look like this. You will be at that $3 million plus mark, right? And I'll put up a chart on the screen that shows the actual difference, right, if you say invest versus save $200 or whatever the number is. But generally, you're looking at, say, like $300,000 versus $3 million. You're looking at a 10x plus difference by just investing in the stock market versus saving, right? And that's because your money works for you. Now let's think about why that actually happens, right? And again, this is fundamentally, well, why should you invest? And again, let's say we earn $800 a week and we save $200 a week. And let's think about this in terms of years. If you save $200 a week, you're saving $800 a month. That's $9,600 a year, right? So we're saving $9,600 a year. If we do that again for 10 years, we're going to get $96,000. Now, if we invest this, let's think about this again. The first year, we put in $9,600, right? That is the balance of our, say, stock market investment portfolio. But let's say we earn a return of 5%, and that means our money is going to make 5% because we invest it, say, in a stock. And we'll cover really what all this means in just a little bit. But let's say we make 5% on our money, right? We're going to make 10% is 960, so $480 is going to be our 5%, right? So we profit by $480 right there. Then we get into year two, right? In year two, we have $9,600, so the original amount we invested, in addition to this $480 in profit, which means our total balance, just off the top of my head here, is going to be $10,080, right? Now this $10,080 makes 5% again, right? Now remember, the first year, 5% was $480, but now that $480 also makes 5%. So now our 5% of $10,080 is what, $540, right? So in 1 year, in our first year, we made $480. In our second year, without adding any more money, we made $540, right? We made $60 more. And that is, again, with the same amount of money. Now, meanwhile, if we save, right, if we put another a set amount of money in, let's say another $9,600, right, that's growing like this. That's 9,600, then what, 19,200, and so on. But here, right, this $60 is everything. That's so critical because this wasn't us working for that money to put more money into stocks. This was the money making money, and then the money we made, this $480, also generating 5% a year, right? And then again, let's say without putting more money and without putting another $9,600 in, this $540 brings our total balance to what, $10,620, right? So this becomes $10,620, and that's going to be in year three. Now that $10,620 will make 5% more, right? And 5% of that is going to be a little bit more than $540. It'll be over $600, right? So in that way, by function of our money making money, right, over time, right, we're going to have an exponential increase in our portfolio, right? We're going to make a lot of money. This also illustrates why it's really important to start investing young, right? Because you'll notice, let's say this is year 5, this is year 10, this is year 20, and this is year 30, right? If you start investing when you're 40 years old, right, and you want to retire when you're 60, you only have 20 years, right? 20 years is a long time, that's fantastic, but you're only going to get, right, this amount of money. You're only going to get up to here on this exponential graph. Meanwhile, if you start when you're 20 years old, right, by the time you're 40 years old, you've been investing for 20 years, you're already there. And then when you're 50 years old, right, and let's say you want to retire at 60, your portfolio is there because that money just keeps on growing. It's like a snowball that just rolls down a hill and keeps getting larger and larger, right? And then you can just imagine when you're 40 years old, right, you're in such a better place. And that's why, you know, any amount of money you can invest when you're really young is going to make a lot of money for you down the line, right? It might not sound like a lot to save $100 or $1,000 this year, but if that money 50x's, right, over the course, again, that's say $1,000 by the time you're 50 or 60, now you have $50,000 or $60,000 then, right? And that's going to mean a lot more when, you know, you want to retire or just generally, right, if you want to start a business, if you want to travel, whatever you want to do, you're going to be better off having more money. That really is why investing is so important, and then also why it is so important to start investing as young as possible. And I really suggest you do send this to kids or friends you know if you are younger, you know, or you have your own kids, because again, this is what will change really their financial horizon and opportunity just for the vast majority of people. Now, if we think about the stock market as a whole, right, it on average grows by about 10% a year, right? And this varies. You see 6%, 8%, 10%, various numbers at different times. And it is volatile, which means it's not always 10%. Sometimes it's 5, sometimes it's 15. But let's just, for sake of simplification, say that's 10% a year. That means every dollar, or let's say every $100 we put in will make $10 on average per year, right? So again, with compound interest, right, we put in $100, we get 110. 110 goes to 121 because our $10 makes 10% in year 2, which is $1, and so on. So generally, you're going to make about 10% a year in the stock market, right? And we'll get into what the stock market actually is and why it functions like that. But generally, right, that reflects economic performance. So if the economy is, or the GDP is growing by 4 to 5% a year, that's really good. Let's say more 2 to 3%. Your stocks or just the value of companies is going to grow by, say, that 8 to 10% a year. We also have to think about inflation, right? And this is what's critical to the value of investing, and also why it's really, really dangerous to not invest, right? Because in our earlier example, we thought about that $9,600 that we save over the course of a year. Let's say we don't invest this. If we don't invest this, and let's say inflation is 3%. And we've all heard a lot about inflation, right? It's all over the news all the time. All that it means is that goods and services get more expensive, right? It's like they inflate, they get larger, right? So if groceries used to cost $200, now they're going to cost $206, right, this year, and then 3% more than $206 next year, and so on. What that means is the amount of money in your bank account doesn't go down, right? But you can buy 3% less of actual things with it, right? So let's say before we could buy, again, we wanted to buy groceries or G, and we could buy 100 units of our groceries, right? Well, we have this $9,600 in a bank account, and then in 1 year, we still have $9,600 in a bank account, right? But now we can only buy 97 units of our groceries, right? Let's just say that's grapes. We used to be able to buy 100 grapes. Now we can only buy 96 grapes. Again, not at 3%, just generally let's imagine what that looks like, right? Then let's accelerate to year 4, right? And this is year 1. At year 4, we still have $9,600 in this bank account, but now we can only buy 70 grapes, right? So even though it doesn't feel like you're losing money, you can actually do less with the money, right? Which means the actual value, the real purchasing value as it's called, is decreasing, right? So that's why if you don't invest, right, if your money doesn't make you money, you're actually losing money all the time. You're losing the value of the money. It's going down right now by over 3% a year in the US. In the UK and a lot of places, that's double digits, right? That's 8 to 15%. In Turkey and a lot of places in the world as well, that's a lot higher, right? So that really is why, again, it's so important to invest in things that will make you money. Because then what happens is, we can think about investing as this. If you just leave money, if you quote unquote save it, if you leave it in a bank account or in cash, what it's actually doing, right? Its effective purchasing value is doing this. It's just decreasing, right? So investing is your money making you money, right? Anything else than investing, in whatever form, that's going to lose you money over time. And I know I'm beating a dead horse here, but that is why investing is so important. Okay, now let's consider what a stock actually is, right? And this is the first sort of term in our terms section, right? You'll also hear this referred to as equities. They kind of mean the same thing, and we'll get into what that means. So when you start a company, right, you're going to issue a certain number of shares, and that is just a part, right, a unit of ownership, right? So let's say I start company A, right? I start company A, and to start company A, I issue 100 shares, and that just means that the value of my company, the ownership of it, is divided into 100 parts, right? So each of these shares is worth, say, 1% of the company just when I start it, right? Then let's say I own 100% of it because I started it, right? I run it for a few years, and now it's making, right, $1 billion a year. It's doing extremely well. Now I want to go public, right? And what that means is I want to list these shares, right? And I want other people to be able to buy them. I want to go on a public market with them. Any company on a stock market, and we're going to get into what a stock market means, but any company on a stock market is public, right? Anyone in the public can own shares of them. And again, shares are just, well, hey, I started my company, and this is a part of the company. This is a little piece of ownership, right? But now I'm making $1 billion, right? And in the case of 100 shares, the pie is somewhat like this, right? We have 100 shares, and let's say I own all 100, but then maybe I want my mom to get in on the action. I want her to own some part of my company. In that case, maybe I'll give 4 of those slices to her. If I give 4 out of 100 slices to her, she owns 4 shares in my company, right? But then now I'm making $1 billion a year, right? I'm a big deal. My company's doing very well. Now, as opposed to 100 shares, I'm going to split those into smaller parts. And let's say now I have, right, 100 million shares, right, versus 100 shares. So just, 1 million times more. It's the same exact thing as here, right? Before there were 100 parts of my company, right? It was the value of it was split 100 times over. Now it's just 100 million, right? So it's just this, but there's 1 million times more squares. Now before, again, let's say I put in $1,000 to start company A. The company was worth $1,000, and there were 100 shares. That means the value per share is $10, right? Here, let me erase this. If my company is worth $1,000 and there are 100 parts in it, right, then it's just each part is worth $10. Now I'm making $1 billion a year, and my company is worth, let's say, right, $10 billion. So my company is worth $10 billion, and I have 100 million shares. Well, it's the same exact calculations. It's just my company is worth, here, let's write this out, $10 billion, and then I have 100 million shares. So if each share was worth $1, it'd be a $100 million company. If they were worth $10, it'd be $1 billion a billion-dollar company. And if each share is worth $100, right, then you get to that $10 billion market cap. So same exact thing here, right? The company is worth this amount. We have this many parts of the company. So if you own one slice of that, one share, right, that share is worth $100. Now, that's exactly what the stock market is, right? If you go to the stock of a company, it's just a little piece of ownership of the company that you're buying. And if the company is worth $10 billion and you own one share out of 100 million, and that's say of Apple, of Nvidia, of Microsoft, of whatever the company is, right, then this is how the value is determined. It's just the value of the company divided by the number of shares that exist. So that's what a stock is, right? It's just a piece of a company. Now let's think about what the stock market is. A stock market is just a collection of stocks. So let's say, let's use real examples here, right? We have Apple, we have Microsoft, we have J&J, right? We have these three companies. The way it used to be, the way it was originally, was just Microsoft has its stock, right? They have their 100 million shares of their company, and Apple may have 1 million shares. J&J might have 10 million. They all have their own companies and shares. But then, right, let's say they want to raise money. They want to, let's say Apple wants $1 billion to go build a new facility. If they want to do that, they need to get the money from somewhere, right? They need to get that $1 billion. One way for them to get the $1 billion is to sell some of the shares of their company. Because again, what we just said is, every share has value, right? Every share, let's say, is worth $100. If a company is worth $10 million and we have 100 million shares. So now Apple wants $1 billion. They need to sell some equity or some shares of their company to go get that $1 billion. So let's say they're worth 10 billion, right? And they need to raise, they need to get $1 billion. Well, if they have 1 million shares and their company is worth $10 billion, they can list 100,000 shares or sell 100,000 shares, right, to go get $1 billion. And that's because 1 billion is 10% of the value of the company. So if they sell 10% of the shares or the parts of the company, they're going to get the $1 billion. So the next question is, well, where do they go in to sell this, right? Where do they find people who want to buy their 100,000 shares? Well, let's say you think Apple is going to increase in value. It's worth $10 billion now. You think that's going to go to 100 billion. You think it's going to go up by a factor of 10. It's going to 10x in value. If you think Apple is going to go from 10 billion to 100 billion in value, right, you want to own a piece of that. Because if the value of the company goes up, then the value of the shares go up, because the shares are just parts of the company. And let's say you're a normal person, right? You go to work, you go to school, whatever it is, but you want to make money off Apple. You believe in Apple. You want to buy shares. Apple wants to sell you the shares. The natural result of that is a market, right? A public marketplace where people can buy shares of companies that they believe in, that they think are going to go up, right? And then the result here is, you give Apple $100 now for a share because you think you're going to have $1,000. You think it's going to increase by 10x, right? Apple does that and gets their $1 billion, right? Your $100 and the $100 of a lot of other people, and they go and build a facility, right? And life is great. They use that money to go and build their company to get to that 10 billion. Meanwhile, if the company goes up, you make money, right? So the company's better off, you're better off, everyone generally is better off, right? That's why the stock market works. And then all these other companies want to do the same thing. Microsoft, right, wants to list 10 million of their 100 million shares. J&J wants to list 9 million, right, of their shares, and so on and so forth. So the stock market overall is just this big bubble of all these companies, like a public marketplace, right, where you can go and buy shares of companies and they can go and sell those shares. And then what we figured out before, right, is that every share has value and you're going to invest if you think it can go up, right? let's then think about the open price or the price of a stock, because again, this is a market, right? There are buyers and there are sellers. So how do we figure out, what the actual stock is worth, right? And the actual value of the stock is determined by the market. So let's just illustrate that, right? Let's say I own, right, stock. I own one share of Apple stock, and I'm willing to to sell my stock for, it's worth $100. I'm willing to sell it for $102. This guy, he wants to buy it. He thinks it's going to go up, but he doesn't want to buy it at $100 because he thinks maybe it's going to go to $104, right? So he's willing to pay $96 for it, right? And then there's someone else who's willing to pay $95 and $94. There's someone else willing to sell for $103 and $104 and $101, right? So there's all these buyers and all these sellers, or people who want to buy or people who want to sell. Ultimately, the intersection of these two is the market price, and this is what determines the share price, right? So if the person who is willing to sell for the least amount of money is willing to sell for $101, right? And then the person who is willing to buy for the most amount of money is $101, and now a lot of people want to buy for $101, right? Prices are in equilibrium. You have people willing to sell for $101 and to buy for $101. If that happens, if the price used to be $100, now the price is $101, right? And if people start wanting to buy for $102 or $103, people will continue to sell only at that higher price. No one's going to sell for $97 if the stock is the market says it's worth $101. So now the price goes to $102, then $103, and so on. So in that way, the market determines, right, via just buyers and sellers, the price of a stock. And all a stock price is what people agree it's worth, because it's real time people willing to buy or sell that stock. Now, before we said, a stock market is a bubble of companies, right? A marketplace where you can buy and sell shares. Now, what I want to make clear is that a stock market, in that sense, is owned. It's like it is a marketplace, but it's a private marketplace, right? That a certain company owns. So if we think about, say, NASDAQ, right? The NASDAQ is a stock market exchange, and the stock market generally is just a market for stocks, for shares, right? A stock market exchange is where you actually go to buy and sell those, right? Because someone has to manage that. If I want to go into a computer and buy 100 shares worth of Apple, right, someone has to manage that. Someone has to make it happen. So what you see are what are called exchanges. And this is just like an exchange desk where you go, say, to exchange bills of different currencies. It's just like that for the stock market. They just manage that, right? So you can think of the US stock market, right? But the actual stock market breaks into different exchanges. And this is just the people who manage, right, the listing and the buying and selling of those stocks. So you'll never really run into this. Like you're not going to go onto NASDAQ and buy a stock through there. And we'll talk about how you actually can go and buy stocks in a little bit. But just keep in mind that generally your bubbles of stocks, right, your stock markets with Apple and Microsoft and Nvidia, they're going to be on, say, the NASDAQ exchange, right, or the Dow exchange, or every country will have their own stock market. So China will have a stock market, the Swedes have a stock market, and some stock markets may have multiple. Some countries may have multiple exchanges, right? And the biggest one in the US, right, you have the New York Stock Exchange, or the NYSE. Okay, so we looked at this example, right? All these examples of companies that issue shares or issue stocks and then join a stock market. I want to put some terms on those things, right? So if we think about an IPO, you'll hear this term often. IPO means initial public offering, right? So if I'm Apple and I completely own my own shares, right? I own all million of my shares, and then I want to list on a stock market exchange, or I want to make that public so other people can buy my shares, right? When I do that, that's called an IPO. And you'll often see videos of companies where they're ringing a bell on a stage, right? Or the people who started the company or the executives. That is them listing for the first time. That's when their shares were private. Now they make some of them public. Now you can buy and sell them actively. And then before we spoke of the total value of the company, right? We had the $10 billion, we had the $1 billion. Let's say your company is worth $1 million, right? And you have, let's say 100,000 shares. And then our price, right, is going to be $1 million is the company value divided by, I've got a zero there, 100,000. That's going to give us $10 per share, right? $10 a share, 100,000 shares. It's going to give us $1 million of value, right? If a company is worth $1 million, what we're going to call that is the market cap. And this is what you hear about all stocks, right? So if you go search up any stock of any public company, you're going to see something that says market cap and it'll have a number. That number is just the value of the company, right? So the market cap or the market capitalization is just the value of the company. And then the number of shares outstanding, right? That's just the number of public shares. And then the price, the open price, the strike price, there's different terms for it, is just how much each of those shares are worth. Now, one core concept to touch upon here is dividends. So let me write that down. You might have heard about this as well. You may also hear about the word yield, right? And that is going to be a very similar concept here. If you own shares in a company normally, if you own all of a company, you get all the profit from it, right? Stocks don't necessarily work like that. Just because you own a part of the company doesn't actually mean you're entitled or you get some of the actual profit from the revenue of the company. Instead, some companies offer what are called dividends, and this is essentially the company paying you to own part of the company. It's them taking some of their profit or their revenue and giving that to you. So let's construct just an example here. Again, let's say you have $1 million market cap. You have 100,000 shares, and you have a $10 price, right? Let's say this company is going to make $10 million this year. And they decide we're going to, with 1 million of those dollars, issue dividends. And dividends are distributed equally among people who own a stock. So again, there are 100,000 shares. Let's say there are 100,000 people that own one share each, right, in this market. They're going to distribute the $1 million to the 100,000 shareholders, right? They're going to give them $10 each. Now, this would be amazing, right? If you have a stock worth $10, and then they give you $10 just to own the stock, you just made 100% return. That's incredible, right? This is fundamentally exactly what happens. It's just you see much lower numbers, right? So take J&J, right? Johnson & Johnson, it's a very big pharmaceutical company. I don't remember exactly what the stock price is at right now. Let's just say it's at $300, right? Right now, they're going to pay you, let's say, $5 a year in dividends, right? So that means for every share you own of Johnson & Johnson for $300, they're going to pay you $5 a year just to own it, right? And that's essentially, again, normally when you buy a stock, you want the value of the company to go up, and then you could sell to someone else for a higher price. This is, I get some of the profit of this company, right? I'm actually making money. They're paying me just to own this. And then the dividend yield, or that's the percent amount, right? So to make this easy, let's say their dividend is $6 per year, right? They're going to pay you $6 a year per share you own. So if you own 10 shares for $3,000, right, they're going to pay you $60 a year, and so on. The dividend yield, or the interest yield, right, is going to be the $300 divided by the $6 is going to be 0.02, or your 2%, right? And the actual here setup, let's do this correctly, is going to be 6 over 300. Again, that's going to be 2%, right? 1% of 300 is 3, 2% is going to be 6. And And again, this is just how much they pay you purely to own the stock. So in that way, you can make money in different ways. You can make money just by owning a stock, right? Because let's say the price of J&J is $300 right now, but then 1 year from now they release a new drug, right? And then now they're worth $400 a share, right? Well, let's say you bought your 10 shares at $300. You still own 10 shares, except now they're worth $4,000. So you spent $3,000, you bought for $3,000, and then you're going to sell for $4,000, right? You just made $1,000, and that's one way of making money. But if you bought 10,000 shares and they offer a 2% dividend, right, you're going to make $60 a year. So 1 year from now, you're going to come out actually with $1,060 in profit. You're going to make $60 extra. Then extrapolate that into 10 years, right? Remember what we said too about compound interest, right? That $60, you can invest it back in the stock and it can make 3% more per year. But generally, right, the longer you hold a stock, if they offer a dividend, right, the more money you're going to make from the dividend, making more money, and so on. And generally as well, you can make money either by owning a stock and then paying you dividends, or by the actual value of that stock increasing. Now let's think about the chart of a stock over time, right? Let's say this is going to be price. I'll write that out. And this is going to be the date, right? Or the time throughout which you hold a stock. If a stock right now, let's say it's at $200, right? And this is now. This is the present or end, right? If 1 year from now, I'll come over here, right? This stock is at, right, $100, and then 2 years from now, let's say it's at $400. It did really well. This is a volatile stock, and volatility is a measure of change. Volatility is rate of change, right? So this stock was break even here, it crashed over here and went down to $100, and then it went back up to $400, right? This is a very volatile stock. It goes up sometimes, it goes down sometimes. It has all this different price activity. Then let's say we have stock number 2, right? Stock number 2, as opposed to going from 100 to 400, right? Starts out at 400. In year 1, right, it hits 300, and then at year 2, right, it hits 400. Now, both of these stocks did in fact reach $400. And here, let me just make a smaller graph. This stock went like this to hit 400. And then let's make this cleaner as well. This stock went up to hit 400. Both of them started at 200 and ended at 400, right? But this stock is more volatile. This one is more stable. And you can think of volatility as just the opposite of stability, right? A lot of people prefer more stable stocks, right? Because, in this example, you never lose money. Your money just never goes down. While this one, you do lose money initially before it goes back up. But some people like the risk as well. They like to, make money because generally, you are going to see a correlation. And this is covered in one of my books. So if you've read that, you'll be familiar there. But there's a risk and return relationship, right? There's correlation, and that means when risk goes up, return goes up. When risk goes down, return goes down. You can think of this with everything in life, right? If you play it really, really safe, if there's very low risk, if something isn't volatile, right, you're going to see fairly low return, right? Like let's say, again, just you're going to ask someone out, right? Let's say dating or your love life. If you ask them on a date, right, there's a level of risk there. You could get rejected. But if it goes well, you get the return, you get the payoff of going on the date. And then extrapolate that into, the second date and the third date and so on. Meanwhile, you could also just not ask them out, right? In which case the risk is 0, but the return is 0 too, right? Because you also don't get the date. Finance works exactly the same. It just works more accurately because there are lots of people involved. And the more people involved, the more stable things become in terms of this relationship. It works the exact same in the stock market, right? Your risky stocks, your stocks where you could lose money, could also make you more money. Meanwhile, your really safe stocks aren't going to make as much money. And let's take J&J, right? Let's say J&J is at $200, and a year from now, it's at $210. You made 5% on your money. That's great, right? But 5% isn't an incredible return because let's say other people are investing in Bitcoin and making 50%. That was limited risk because it's J&J. It's not going to go down, right? They sell things everyone needs like Band-Aids and drugs and so on all the time. They're not going to go down, but you're not going to make a lot of money. Let's say you make your 5%. Meanwhile, right, let's take Bitcoin. Bitcoin could be at, let's say, $100,000 a year from now. It also could be at $10,000 a year from now, theoretically, let's say, right? In this case, you could make off your, let's say, $10,000, you could make a 10x return, right? Or 1,000%. And that's really high. If you make that, that's incredible. But you also could lose your money, right? So this is a more risky asset, but there's also higher returns. In the case of J&J, right, you have lower risk and also lower returns. And you have as an individual your risk profile, right? You have the amount of risk that you want. If you're older and you're going to retire in 5 years, right, you probably want low risk. You don't want to lose your money. Meanwhile, if you are younger, right, you may seek out risk because risk on average may produce higher returns. You may make 10% versus 8%, but some years you may lose money. And I said earlier that the stock market will make, here, let's move this chart a little lower down. It'll make on average 10% a year. When I say it makes on average 10% a year, really it's more like 8%, but let's call it 10% over the past 50 years, right? It actually could look like this, right? This year you lose 5%. This year, you make 25%, and so on and so forth. So what this means is that it's much better to invest in the stock market over a long period of time because the trend line here, the average, right, is always positive. It's up. But at some points you're going to lose money right here and right here, right? Let's say year 2, year 4, year 5 and year 6 are really good, and year 3 was also good. Some years you win, some years you lose. Overall, you make money. And once more, and again, I know I'm beating a dead horse, but that's why it is important to start young and invest over a long period of time and invest consistently, right? Because if you only buy, right there, or you only buy right there, you could lose money for a year or two on this investment, right? And right here, you're going to lose money, but then it might crash after that, right? If you buy all the time, if you buy $100 a year, every year, the $100 here is going to make a lot of money. The $100 here is going to make a lot of money, and so on and so forth, because over time, things will make money. Now, there's these different periods in the stock market, right? And once more, let's clean this up. Let's say this is the overall price for the stock market, like theoretically, if one price represents the stock market. And let's say it looks like this, right? This is price. During this period, it goes up, and you know what? Let's say this goes well. Let's say it goes up, and the stock market does usually go up. It's down here, it's down there, and it's down there, but it's usually up, right? You have what's called bear versus bull markets, right? You may have heard this term. If you go to New York, to the New York Stock Exchange, you'll see the big statue of the bull, right? Bull just means up, and bear just means down, right? So if you're in a bull market, if the stock market is in a bull market, that's one of these periods, right? Where stocks are going up, where everyone's happy and making money. And then these bear periods are when prices go down. So if you hear like, oh, it's a bear market, oh, the bulls are getting us today, and so on, that just means, bull is green, bull is you're making money, bears are losing money, bear is red, right, equivalent. And you'll hear bear market. Again, the bears are people who think the markets are going to go down. and so on. That's just some slang there. Okay, there's just 3 more terms I want to cover here. The first of those is going to be, or I guess the first 2 are going to be first quarters, and then we're going to get into analysts and insiders. This is, let's say, a year, right? We can think of anything related to finance on a yearly basis, on a calendar year, right? Because if you become a public company, you have to do a few things. There are requirements that come with that. You have to issue what's called an annual report, right? And that's just a report, right? A bunch of numbers. They just say, okay, we made this much money a year, we lost this much money a year. Because if you're selling your shares to the public, you have to be transparent. You have to be honest about how the company is doing. So as a shareholder, as a part owner of this company, right, you are going to be entitled to all the information about how the company is doing, right? One of the ways you get that is the annual report. You also get those in quarterly reports, right? So we can think of the calendar year is being broken down into 4 quarters. We have quarter 1, quarter 2, quarter 3, quarter 4. And that's just every 3 months, a company has to issue their quarterly report. Now, this is really useful because it gives you a ton of information about how the company is performing, right? So if I'm Apple, if I'm an Apple investor, I want to know how many iPhones they sold. I want to know how much money they made, because if they, made more money, the stock price could go up, I can make money. And, if they didn't make as much money, if they didn't sell as many iPhones and demand was weak, or they think demand is going to get weaker, or costs rose, or whatever it may be, right? I want to know, because I may be losing money there. So every stock, every publicly issued stock will have these reports every 3 months, and you'll often see prices move because of them. So if Apple stock is at $100 now, and then there's a bad report, they may go to $80, right? And if in quarter 2, if they have a great report, if demand was strong, that may go back to $120. This is very much something every few months that moves the stock. You'll also hear your earnings season, right? And that's just every few months, a whole lot of companies come out with their quarterly reports, and that often moves the market, like the overall stock market. Because if all tech companies did well, the overall market may rise, and vice versa. If a lot of companies are doing poorly, the market goes down as well. And we'll cover, in a little bit. I keep using terms like the market here. What I more mean is indexes, and we're going to talk about that shortly. But again, there's analysts, and these are just the last 2 terms we'll cover here. And then there are insiders, and you're going to hear these terms thrown around a lot as you invest, right? Analysts are people whose full-time jobs are to analyze companies and to figure out whether the stocks are going to go up or whether they're going to go down. So your Goldman Sachs, your investment banks, right? All those companies employ analysts that, again, their full-time job is to say, hey, is this stock price going to go up or is it going to go down? Is the company going to do well or is the company going to do poorly? Now, what you'll often see on brokerages, which are where you buy stocks, right? So, or just in your investment account, right, is you're going to see a bunch of analysts that think different things about a stock. And you may have one analyst that thinks stock A is going to go up by 40% and another that thinks it's going to go down by 20%. And some analysts are better than others. Generally, analysts will often issue reports about what they think a company is going to do, as in whether they think the stock price will go up or go down. Those are often really useful to read into. What I will say is that, you have analysts A, B, C, you have all these different guys. They all think different things, right? No analyst is a genius. I highly recommend doing your own research and not listening just to one analyst. But overall, if all analysts think a company is going to do well, it's probably going to do well, and vice versa. And overall, that's a great source of information. Now, every time you go to a stock chart, right, in a brokerage or in an investment account, and we'll get into what a brokerage is as well, you're going to see a little tab as well that shows a graph, and this is in addition to the price graph, and it may look like this, and it may have a list of different insiders like the CEO, and it'll show when they bought or when they sold the stock. As a CEO, you're allowed to sell your own stock. You can also buy your own stock if you think it's going to do well. There are rules to that, but generally you can. So if you see that, the CEO of a company you want to invest in just bought, $10 million worth of that stock, that's pretty good, right? If they keep doing that over time, they probably think their own company, their stock is going to do well. Meanwhile, if you see that, say, the president and the vice president of a company just sold a lot of their own stock and they keep selling their own stock, that's probably bad, right? So cumulatively, analysts and insiders are two sources of people that generally do this for a living. Either they run the company of the stock you're thinking about buying, or their full-time job is to research companies like that. So those are both two sources you really do need to pay attention to when you're doing your research and when you own a stock. Okay, now we're going to think about different types of investments, right? We just looked at a whole bunch of terms. First, we're going to get now into types of investments and then into types of stocks specifically. Overall, stocks are the most common form of investment in the stock market, right? And that's just buying shares of a company. And shares and stocks, if I didn't make that clear, are interchangeable, right? So you buy a stock of a company, but it doesn't stop there. And let's think about, let's say you want to buy a technology stock. And let's think about this through the lens of risk, right? Pretty much everything done in finance is just, the amount of risk associated with a given asset. So let's say we'll return to Apple, right? NVIDIA, Microsoft, and let's say Activision. And even though Stripe isn't public, let's just mention it is for a second, right? These are 5 stocks. They're all in technology. So you have Apple, they sell computers, NVIDIA, they are involved in AI and GPUs and so on. Microsoft does more hardware in addition to software, so computers, but also your Office suite of apps. Activision does video games and Stripe does payments, right? They all do different things. Now, again, you remember what I said of the stock market generally will go up over time, but sometimes, it'll go down, sometimes it'll go up. So if you buy in any one year, you might make a lot of money, you might lose some money, but overall it's going to go up. Well, the same applies to these stocks, right? If we just buy any of these stocks individually, Apple may make 20% this year, NVIDIA may make 40% this year, Microsoft may lose 40%, and Activision may go down by 10%, and Stripe goes down by 10%. If I bought any one of these stocks, right, sure, I might make some money, but I may lose some money as well. And so because of that, you see these bundles of stocks, and those are called either mutual funds or index funds. So here, this on screen. You have a mutual fund, and fund is the key word there, and then an index fund. So what a mutual fund does is it distributes money across a whole lot of different companies, right? So let's say I'm investing $100, right? And the share price of Apple is 200, the share price of NVIDIA is, 1,000, Microsoft is 400, whatever it may be. And I have my $100. If I wanted to go buy, say, Apple, right? I could put all my money into Apple, but then, I may make 20%, but I might lose 40%. It's a gamble. So what the mutual fund is going to do, they're going to take $100 from 10 people, right? Or let's say from 1,000 people, right? So they have their $100,000, and they're going to go put some amount of that in Stripe, some in Activision, some in Microsoft, and NVIDIA, and Apple. So that way, the price of a mutual fund, and the mutual fund does also have a share price in a sense, reflects all of these. It's an average, right? It's a weighted average of all of these stocks. So, right, in this case, we have 20%, plus 20%, plus 40%, minus 40%. These cancel, and then -10, -10, and 20. So these cancel as well. So in this case, even though you have all this volatility here, the price of a mutual fund, right, is really just break even. Because if you bought just a little bit of all of these, right, the same amount of all of them, sure, each one may go up or down, but if you invest a little bit overall, that's going to break even. So what that means is, sure, you didn't make money, you didn't lose money, there's less risk. And again, more risk, more return, less risk, less return. So what a mutual fund does is just limits your risk by spreading that risk across multiple investments. So, in that example, that's break even. But let's say, right, stock A does this, stock B does this, and stock C is kind of break even. The mutual fund will be up just a little bit, right? And this stock went down a lot. This really went up. This one was kind of break even, right? By buying the mutual fund, we don't have to take the gamble of, well, am I going to buy the stock that goes down just by pure bad luck? Instead, right, we just buy this and it goes up over time. And that is essentially what a mutual fund is. It is just a collection or a bundle of stocks. Now, there are two terms here, right? There's mutual fund and then there's index fund, or two types of investments. A mutual fund is actively managed, right? So I spoke of analysts earlier whose full-time job is just to figure out what stocks are good and what aren't. A mutual fund can be managed by analysts, right? So they are going to full-time take your money, right? And then they're going to go buy, say, 100 stocks, not just 4, right? They're going to take your money to go and do that. And then hopefully, right, they make you money. And let's say, the price of a mutual fund is $50 now. Maybe they invest well and then it goes to $60, right? And you put in $100, you bought 2 shares, you get out 120, you made your 20% return. An index fund is very similar, except it's not actively managed, right? So that just means you may have an index fund that automatically buys the top or the largest 100 companies in a country, right? So in that case, you put in $100 and the equivalent of $1 of all those 100 companies would be purchased. Now, you might think, well, why don't I just buy a mutual fund because I have professionals managing it? That's because they charge a small fee, right? Let's say they charge 1%, and this is a management fee, right? So if you buy a mutual fund, you have other people investing your money for you, and they do this full time. They're probably good at what they do, or we hope so. Sometimes they aren't. They may charge 1% to do that, right? So if it's $50 now, if the share price of the mutual fund is $50 now, and it's going to be $60, right? They actually take 1% of that. So instead of making $20, you make, say, 20 cents less than that $20. And then your index fund is just default, like, hey, you're buying, some computer will manage that. You're buying, say, the largest 100 companies in, say, the US or Mexico or something of that sort. And you do have a few very large indexes that represent generally, say, in the US economy, or in China, the Chinese economy, and so on. In the US, that's like the S&P 500 and the Dow Jones. The S&P 500, or the Standard & Poor's 500, is just the 500 largest companies with some bounds on there in terms of profitability, but generally the 500 largest companies in the country. Same with the Dow. You also have the QQQ, the Spider, and so on. These are all indexes, just funds that are in sum just a lot of different companies that are represented under one all-enveloping share price. So say $80, that buys you a little bit of all those companies. Now briefly, I want to touch on what's called a REIT, or this is REIT. This is a real estate investment trust. If you hear this term and it's somewhat niche, that just means you're buying a company that goes and buys a whole lot of buildings, right? So if you buy into a REIT, they may own 800 buildings or houses, and then they may go and develop and rent those out, or so on. That's a very niche term, but you'll hear that often, and REITs are known for being fairly volatile or risky. Now I want to think about 2 final types of investments, right? We went over stocks, mutual funds, index funds, and then REITs. These final 2 are options and shorting. I think you need to know about these. They are important and fundamental parts of the stock market and financial markets as a whole. However, these are really, really risky things. They're very high return if they work, but they're very risky as well. So I don't suggest investing in these. You should really just stick with, stocks, just basic stocks first. But let's start with options, right? And let's say we have a stock that is $100, right? This is an asset. We can buy it. If we own it and it goes up, we make money. If we own it and it goes down, then we lose money. You also have what are called derivative assets. And derivative assets are based on the original asset, but there's kind of two layers there, right? You have your stock right here, and then hidden under that, right, based upon that is your derivative metric. And that may sound confusing, but let's just think about that. Let's say this stock, we don't know what the stock is going to do, right? The stock is at $100 right now. It's been going down, just came up a little bit recently, but it's at a price of $100. Now let's say we want to bet upon how it's going to do, right? Let's say I think it's going to go to $120, but you think it's going to go to $80. So we're going to bet whoever is right is going to get $50, right? And that's just between, say, a friend of mine and I. If we do that, we're entering into a derivative game, right? Because we're betting on the original amount, but this asset, this game that we're playing, this betting game, right, is based on the original, and we can make money, but it's not the original stock itself. It is based on the original. It is a derivative of it, right? And a derivative in calculus, if you're familiar with that, is just based on the original, right? Just dy over dx. So in this case, that's just a derivative asset based on the stock. And then you have a few types of very common types of derivative assets. The most common is going to be options. And again, this is really risky, so don't do this. So there are two types of options. There are call options and put options, right? Options essentially are just coupons, right? That give you the right to purchase something at a future date at a future price. And let's think about that in terms of a coupon, right? Like literally a coupon. Let's say we have a pizza, right? And this pizza right now sells for $10. But you go to the grocery store and you get a coupon, and this coupon says, hey, you can buy this pizza for $8 for the next 6 months, right? The current price is $10. This coupon that, say, the owner gives me at a grocery store gives me the right to buy a pizza for $8 for the next 6 months. If I walk into the pizza shop at any point over the next 6 months, they're going to give me a pizza for $8, even though it says the price is $10, right? We all use coupons or just offers or discounts in our day-to-day lives. This is the exact same thing. Well, now let's say we have two cases in the future, right? And this is, say, 6 months out from now. Or let's say on month 5, day 20, like right before this coupon expires. Our two options are that they raise the price of their pizza and now they sell them for $12, or they dropped the price of their pizza and now they sell them for $7, right? So we have our $8 coupon, and in 5.5 months we walk into this pizza shop, right? If they lowered their price and they're selling this pizza for $7, our coupon is useless because we can get a pizza for $8, but the market price is $7, right? They're selling their pizzas for $7. So in that case, there's no point in buying this coupon. It's not worth anything, right? It's just useless. We're going to go in, we're going to pay our $7. But let's say they raise the price to $12. Now we can buy a pizza for $8, but that pizza is worth $12 to everyone else who's buying it. They're paying $12 for it. So we can buy a pizza. We can buy the pizza for $8, and then it's worth $12. What if we also just sell the coupon, right? We got it for free. It gives us the right to buy something for $8. And then a customer walks in and we tell them, hey, look, you can buy pizza for $8 with this. Why don't you give me 10? If you give me $10, I make $2. I'm very happy. And then you can buy pizza for $2, right? And you save $2 as well. We're both happy. We both save money. In this case, the coupon has value, right? Because you were able to sell it to someone because they save money as well. And maybe they think it's going to go to $14, right? And they think it's going to go to $14 next week, and the coupon is still valid for the next 2 weeks, right? They're going to buy it for me because they think, oh, I'm ripping this guy off. It's going to go to 14. I paid 10. I'm going to make $4 when he only made $2. An option is exactly this. A call option gives you the right to purchase a stock at a future time at a predetermined price. And this is exactly the same as what we just went over. So let's say a stock right now is at $100. Let's say I buy a call option, and this call option gives me the right, let me get down here, to buy the stock at, let's not say 120. Let's say it gives me the right to purchase the stock for $80. And then I pay $25 for this, right? So what this does, and let's say this is for 1 year, I'm buying this coupon that lets me buy the stock for $80, one share for $80 at any point over the next year. And right now it's trading at $100. If the stock in a year is at $150, right? So it went up by $50, right? I can still buy this stock for $80 even though it's selling for $150. Well, now I just pocket the difference and I just made $70, right? Because I just buy it for $80, I immediately sell it for the market price of $150. But of course, this wasn't free. No one's just going to give you coupons to buy a stock. So let's say I had to pay $105 for it, right? I pay $105 to buy it at $80, and then my premium here, what I have to actually pay beyond what I can buy the stock for, is my $25. So I paid total $105, sell it for $150, and make $45. That's all an option is. I won't go more in depth than that. A put option is the exact opposite. It's just with a call option, you think the stock is going to go up. You buy a put option if the stock's going to go down, right? So in a call option, if the stock goes up, you make money. With a put option, if the stock goes down, you make money. And one other type of investment is shorting, right? That is very similar to a put, but not the same. With shorting, you are betting that the stock is going to go down, right? So if the stock price goes up, you lose money, and then if the stock price goes down, you make money. And what this really is borrowing other people's shares. But that's complicated. You can just think of it as, again, you're betting that the stock is going to go down. Now, I just did an hour-long video on debt, just a full sort of breakdown there of, I think, what most matters or should matter to you and what's most important to know when it comes to the matter of debt. I mentioned a lot of debt instruments or debt assets in there, and this is somewhat related to the stock market, but not really by accessory. Right, you're going to see your bonds, your CDs, and your money market funds. Those are primarily what I covered in that video. These are three types of assets that are you can buy on brokerages, right, on accounts where you buy stocks that aren't exactly equities, that aren't associated with a company. But in some cases they can be, right? They don't have to be, but they can be. So if as a company, right, I want to get the $1 billion, like I'm Apple again, I want $1 billion, I can issue shares. I can also just issue a bond, and a bond is essentially debt. It's an IOU where a company says, hey, you give me $100 now, I'm going to give you $10 a year for the next 5 years, and then in 5 years, I'm going to give you your $100 back, right? So in that case, they get money to do something, and then you get money, you make a return, you make a yield on your money. So these are all debt instruments. CDs means certificate of deposit. It's very similar to a bond. It's just companies offer them more so than bonds, and they're slightly different. And then a money market fund is similar to a bond and a CD, except it presents a return constantly, right? So with a bond, you may only be able to get your money back in 5 years. With a money market fund, you can buy out very quickly or instantly, right? So these are all just debt instruments and different types of investments. What's important to remember is that these are lower risk and lower return, right? So the general way to think about the risk lineup here, right? We have, let's just call this risk return, right? Again, risk and returns correlate. The more risk, the more reward, and vice versa. So what we have is, let's put stocks right in the middle. We have bonds, we have CDs, we have money market funds, we have debt instruments over here, right? We have stocks right here, and then we have options there, and then index funds and mutual funds, right, are a less risky version of stocks because you're spreading around your risk. So if stocks are this risky, index and mutual funds on average are slightly less risky. Any bonds, right, they're very, very, very low risk usually, and then options and shorting as well are very risky over here. So that's generally the different type of assets, the different type of investments you can make in the stock market, and then the risk and the return associated with them, with this being maximum risk, maximum reward, this being a lower return, so you make less money, but there's nearly no risk there. So that covers all the different types of investments that are out there. Now we're going to think about different types of stocks, so how to classify an individual stock of a company. The first way we're going to do that is by the general type, and this is sort of the slang type or the way we think about stocks when considering investments. The first of those is going to be value stocks, right? And value stocks are going to be stocks that you buy because you think they're undervalued. And that sounds obvious, but generally we think of a stock of a company as having a true price. And this is what theoretically the price should be at. And people disagree about what it is, but let's say generally the stock is making money. It's going to grow a little bit every year. We think it's worth $100 a share, right? If it's at $120 a share and we think it should be at 100, right? That's bad. We think it should go down as per its true, its fundamental, its accurate price. If the market was fair and wasn't going off hype or just wasn't, the stock price wasn't being influenced by traders trying to, say, manipulate it or make money. But also, maybe the current price is $80, and we think the true price, the true value of the stock or the company is $100 a share. If it's 80, right, it's undervalued. And this relates to value, right? So a value stock is a stock that, for example, is trading, the market says it's worth $80 a share currently, but we think it's worth 100. So you see investors like Warren Buffett, Charlie Munger, guys like that, they make investments in what they think are value stocks often. And these are all usually larger companies, sometimes not, but often large companies that for some reason, right, their price is low when they're making good money, and overall most people agree it should be higher. Then on the opposite side, you have your growth stocks. Your growth stocks are your stocks that are growing very fast. They're growing rapidly. Let's say they're young, they're startups. Often they aren't making consistent profit. Here, let's draw profit. But they're growing very fast, right? So their revenue is up, but they're not stable, right? Their revenue chart may look like this, whereas for value, maybe it's something like this. Growth stocks are your Apples, your Nvidias, your tech companies, right, that are growing fast, and then your whole host of startups like your younger companies. And again, in terms of risk and return, we can think of value stocks as being somewhat lower risk and lower return because they're usually more established companies, and growth stocks have higher risk, right, because they're young, right? They could look like this now, but maybe they could tank because they've only been around for a few years. But then also there is those higher returns associated with them, as in if you catch them right there, you're going to make a whole lot of money. Then we have cyclical stocks. And your cyclical stocks generally perform in line with the economy, right? We think of the overall economy as going through boom and bust periods, right? So let's say this is GDP of, let's say, India, right? The GDP may do this for a few years, and then it does this, and then up and down, right? You have the booms right there, and then you have the busts right there. Your cyclical stocks are the stocks where the companies associated with them are going to do really well when the economy is doing well, and then when the economy isn't doing so well, they're going to do quite poorly, right? So you can think of an example of that as being, say, your luxury handbags, right? When the economy is doing well and everyone's making money, a lot of people are going to buy luxury handbags. They have extra cash. Then when there's, say, a recession and the economy isn't doing so well, no one's going to buy your handbags, right? Therefore, those stocks, those companies are cyclical. Then we have penny stocks, right? You've probably heard this term. It generally has a negative connotation, like, oh, it's a penny stock. Most commonly refers to stocks trading at under $5 a share, so the actual share price. You can also think of this in terms of market cap. So a small stock with, say, under $100 million market cap could be considered a penny stock. These generally just are smaller companies. Sometimes they're newer, sometimes they're not. And they are typically higher risk as well, right? Because if a penny stock is a company that's been going down for 10 years and now it's only at, say, a $3 price per share, for that to reverse and do really well is unlikely. Generally, too, just the lower the market cap, the smaller a company is, the more volatile it is, right? Because less people pay attention. One investor deciding, or one brokerage firm deciding to invest a lot of money can make it go up, and then vice versa. So penny stocks are generally just a low price. They could literally be a stock that's trading at, like, say, 80 cents a share. And generally, there's higher risk and higher returns there. Okay, there's 3 more types here. The first of those is going to be your blue chip stocks. So your blue chip stocks are your very established companies, your industry leaders that have been around for a long time, right? We can think of J&J again. We can think of Dell or Intel. McDonald's. These are companies that have been around, they're established, they're profitable, they're making good money. They're probably not going to crash, right? Like, no one's going to stop buying Coca-Cola. The world won't stop buying Coca-Cola next year. But it's also not going to do incredibly well, right? Coca-Cola isn't going to double in size next year. So these are very, very stable companies. They're typically large as well. And they are known for being predictable, for going up just a little bit every year over time. Then we have income stocks, right? Income stocks are stocks that make dividends, right? That pay you to own them because you get income, right, from owning the shares. So generally, stocks that pay really, really high dividends, they're going to be known as income stocks. Typically, if you pay a really high dividend, your stock is probably smaller. I spoke of REITs, or real estate investment trusts. When the economy is doing well and everyone's buying houses and renting from them, they may pay out 8 or 10 or 12% a year in interest. And it was the same in oil stocks, right, over the last few years. When oil was doing really well, they're paying out 15, 20% a year in dividends. Those would be income stocks. But then there's risk there, right? Because the moment the oil markets drop and the moment real estate stops doing well, then boom, right, they pay you a lot less and the stock price goes down as well. So these are generally riskier if you're talking about really high income stocks, but they also can be stable if you're talking about just stocks that offer good dividends, right, like your 3% from J&J. Then this last bucket that we're going to think about, it's going to be international stocks. Now, this obviously varies as per the country you're in, and that's just stocks from outside the country that you're in, right? So if you live in Germany, any US stock is going to be an international stock. And if you live in, let's say, Mozambique, right, you can buy into an index of just US stocks or an index of just German stocks. And in that way, you can get international divestment or investment into a whole variety of different, say, international firms. And the reason people do that is, again, because you're spreading risk out. If India, right, if their economy is doing really well and the economy of the US isn't doing well, if you buy an international index fund, those are going to balance out, right? You're going to be break even, or you're going to make some slight amount of money. So in that way, people once more buy in international stocks to diversify, and we're going to get into what diversification really means and how you can do that just a little bit later. Right, so this is all one way of thinking about stocks. We have your value stocks, your cyclical stocks, your income stocks, and people often buy stocks based on these this classification, right? So if I want a stable stock that's going to make me a little bit of money every year, that maybe also pays a dividend, right? I'm going to look for blue chip stocks. I'm going to look for income stocks. if I want to buy a stock and I want to hold it for the next 30 years, maybe I'll buy a value stock. Or let's say I think the economy is going to do really well, maybe I'll buy a cyclical stock, and so on. So you can think about the types of investments you want to make and then just work backward through the lens of these different types of stocks. So one other way of classifying stocks, again, is by market cap. We talked about market cap. This is a way of classifying stocks because the market caps infer certain things about the company. I generally just want to give you an idea of scale. So your largest companies in the world are worth just about $2 trillion right now in market cap. So that's Apple, Microsoft, Nvidia, Saudi Aramco, or their national oil company. These companies are worth just about $2 trillion. Those are the largest companies you're going to see, right? Then you have a large distribution, right, all along here. You have your $1 trillion companies, you have $500 billion companies, and so on. Generally, anything over, $100 billion is really large. Anything in the billions generally is large, but anything in the stock market over, say, $100 billion is typically going to be considered stable, right? Because if you have a $100 billion company, you know what your business is, you're making money. That doesn't mean it's a great investment, but it's not going to go anywhere, right? It's not going to go to zero next year. So in that way, $2 trillion is the largest you're going to see in the stock market, and if any company in the world, and anything in the hundreds of billions is established. Then on this tail end, right, you have your $1 billion companies, which are still really large. You have your $10 million companies, your micro, your nano cap stocks. Anything under 100 million, and we just covered this, right, is a penny stock that's considered very small and very risky and volatile. And then between this range of 100 million and say, 100 billion, those are all stocks where they can be risky, they cannot be risky. It just really does depend on the specific stock. So thus far, we've looked at a number of ways of classifying stocks, right, that all impact how you should consider them and how the stock likely performs or acts over time, right? We looked at market cap. If you have a larger market cap, you're probably more stable. A smaller market cap, you're probably more volatile. We also looked at the type of stock by their sort of slang or their unofficial term, like your penny stocks, your blue chip, and so on. Now we're going to look at one final type of stock, and that is by the sector or the industry of the company at hand. So let me just write that out. And this is important for the same reason. It actually impacts how you should buy them. And depending on your investing goals and what you want to get out of investing in a certain stock, right, that determines the sector you should consider investing in, right? We can think about tech as an example, right? Tech is known within the stock market as being volatile, as being, very high growth and growth oriented because it is a really new industry. And you've seen in the last 20 years, right, nearly all of the world's largest companies go from nothing to being, technology leaders at multi-trillion-dollar market caps, right? Again, your Apple, your Nvidia, your Microsoft, and so on. And because of that, if you're investing in a tech stock or in the tech sector or industry, you probably, right, are going to get high returns or going to get high growth. But there's also the risk factor of, well, if this thing slows down, it could do really poorly, right? And then that compares to something like utilities, right? With utilities being your heating and companies of that sort, right? These companies aren't going away. They're going nowhere. People are going to need electricity. They're going to need their heating and so on. And that does differ from the tech sector, in some ways for better and in some ways for worse, right? So if you invest in, say, utilities, you're probably getting a lower risk, a more stable play, even though the returns could be less there. Now I'm just going to write out some other sectors or industries that we can think about the market dynamics of those specific sectors. First off, we can think about pharmaceuticals. This is similar to the the utility sectors, and people need their drugs. If there's a recession, people are still going to go and get the basic health necessities that they need, right? So pharmaceuticals are also known for being your slightly larger, your sort of behemoths like your J&Js. They will produce more stable returns over time. But then you have niches like your biotechs, and biotechs, well, still health related, right? Those are your newer companies that are smaller and focused around one very specific, say, new drug or a few drugs, right? Those may be more risky. They may be betting on one drug that if that gets FDA approval, then it'll do really well, right? So you may have a subset of, say, the pharmaceutical industry, like your quote-unquote biotechs or your biotech startups. Those are going to be more risky and higher return plays. And then we have consumer staples, right? We have energy. We have all these different industries. Here, let me write some of those out. That all have different dynamics, that are all usually trade in different ways. And we talked earlier about the cyclical stocks, right? All of these sectors or industries, they usually are cyclical in that they trade in a certain way. They group together in a certain way, right? So you rarely see half of, say, energy stocks do really well and half do really poor, right? You usually see most energy stocks move together, right? If oil prices go up, if electricity demand is strong, and those are separate energy markets, right? The oil market is not the same as the electricity market, but they're still oftentimes going to move together. And same with tech. Hardware versus software, those are very different things, but you will still generally see tech stocks move together. And that doesn't mean there's a lot of variance within there, within the tech industry or sector, but stocks still generally move together, right, in line with, say, the overall market or perhaps against it, and so on. So in that way, all of these sectors, all of these industries act in different ways, and you can backward induct which sectors or industries you should invest in, right, by considering the standard practices, the standard behavior, or just the norms of these sectors and industries. And that ties overall into how you should pick stocks, right? And we're going to get into strategy a little bit later. But one way you can figure out, and I'll just touch on this briefly, one way you can figure out which stocks you want to invest in is via sort of a funnel, with that funnel being, I want a stock that is high growth, that could do really well over the next 5 years. Well, you can start at the top with the sector, the industry, right? So let's say we want to choose energy. We think energy is going to do well, right? Then you choose the specific product or service you believe in, right? So let's say within energy, we think oil is going to do really well. There's very strong demand for oil, so then we want to go from energy into oil stocks, right? And then within oil, we want to look at, say, smaller companies because we're looking for higher, return stocks. Then we can look at a list of stocks in the energy sector that are in the oil business, whether they're refiners, whether they're drilling, or so on. And then we're going to look for companies that have, say, under $1 billion market cap, right? So relatively speaking, your small oil companies. And then finally, we're going to get a list of, say, 10 companies we can then do further research into. So starting with the sector, starting with the industry is a very common way of approaching investing via a funnel in this way, whereas the alternative is, off the bat, you know which company you want to invest in because you used a product of theirs, you used a service, you think that you had a great experience with that, and you think the company is going to do well, right? But this is a way of, hey, if you don't know what stock you want to invest in or what company you want to invest in, you start with the sector. For that reason, knowing the behavior, understanding these cycles, these standard cycles and behavior of sectors is important. So we've looked at a bunch of different ways of classifying stocks, right? By their size, by their industry. What we have yet to do is look into how to judge the quality of specific stocks, and how to look at one company versus another and say, hey, this is a better investment, this is a better stock to invest in, given that we want to make money and we want the value of our shares to rise, versus, say, another stock. So first we're going to look at fundamentals, at fundamental metrics, right? There are generally a few ways via which people choose which stocks to invest in and how they research and analyze stocks. Fundamental analysis is one of those, right? And I'll get into what that means. Another is hype analysis. And I did briefly touch on this in another video as well. And then your third is going to be technical analysis, right? So every investor in the world does one of these three things. And technical analysis is investing or trading based off the chart of the stock. And technical analysts look for patterns and they try and figure out, hey, if this pattern works in this stock, as in, let's say this is the price of a stock. They'll go and they'll say, hey, this pattern, right, means that the stock is going to go down there. right? And then they look for that pattern in other stocks, and if they see the same pattern, they'll buy, or in this case, they'll short the stock, and then they'll take profit if it does behave as they think it will. It generally is not so formulaic like that. It is more difficult to figure out how a stock is going to move or perform based on purely its chart. And for that reason, technical analysts generally don't do well across the board. I'll put up a screenshot of that. And the ones who do well, they're there 24/7, right? It's their career is just figuring out, hey, these patterns work, these patterns don't, and creating algorithms based on that. So generally, if you're starting off investing, you're not going to talk technical analysis, right? Then hype analysis is exactly as it sounds. It's trading off hype, right? And that could be, and I think crypto is a very good example of this. And this is not as someone who dislikes crypto. I've done a lot of work in the space. I've written several books on crypto. But it is very much a hype-driven space. As in crypto, if you think a bunch of other people are going to get into a coin, right? Let's say Ethereum as an example. If everyone else, right, is buying Ethereum, then you want to get into Ethereum, not because you think Ethereum is a great coin or a great equivalent, right? It has fundamentally great value when it's going to increase in value, but just because you think it's going to go up and then it's going to crash and you want to buy here before everyone else gets in, right? And that fundamentally is trading on interest. It's trading on the hype or the fact that a lot of other people are going to invest and you just want to get there before them. In a similar manner to technical analysis, right? Hype analysis usually is not as successful as alternative means of investing. And that's just because fundamentally you're gambling, right? You're hoping that you get in sooner than other people. And some people win playing that game. Some people do really well. And if they do well, it's because, again, just like technical analysis, they're in there 24/7. They have their ear to the ground. They really know what they're doing. So hype analysis can work. Technical analysis can work. But if you're just getting into investing, you don't want to, I think, pursue those two means of analysis. That leaves us with fundamental analysis. And fundamental analysis is the way in which the vast majority of stock market investors and analysts and professionals and just everyone across the board picks stocks, right? In fundamental analysis, the key word here is just the fundamental, in that you can think of the core of a stock of shares, right, just being what does it do, right? What is the product or service? What's its revenue or what are its financials? And then what's the market and what's its strategy? And these are just some aspects that form the core of a business, right? You can say all you want about a business, about a specific company, but generally, if you consider, hey, what specifically does it do? Do people want that? Is it in demand? Is the market growing? Is the market shrinking, etc.? And then, well, okay, is it making money? Is it going to make more money? Did they make a bunch of bad decisions with debt, right? And now they can't pay people. They can't pay their loans back. And then strategy, right? Based on all these things, what do they think about the market, about their financials, about their products and services? Where do they think that's going to go? And then how are they planning? How are they changing their strategy based on their estimation of these variables? That's just part of, again, that core, that fundamental core of a stock or company. So fundamental analysts trade based off these things. And as an example of that, let's say you just moved to Mexico from the US and you try Mexican food and you say, hey, Mexican food is incredible. Mexican food is really good. It's a lot better than the food back in Nebraska where I lived in the United States. So then you go back to the US, right? And you say, hey, I want to invest in a Mexican food chain or restaurant, right? And you want to do that. Why? Because you think the market will grow. Because you said, hey, Mexican food is good. All the people in my state, I think they'd like it as well. So there's going to be a lot of demand there, right? And then fundamentally, you think the product or service itself is going to do well. So say if you invest in Taco Bell, you think the tacos are going to do well. You think Taco Bell provides great tacos and they have a lot of locations so people can access those products. So in that way, if you choose to invest in the Taco Bell stock, right, you just did so because of fundamental analysis, because you looked at some of these fundamental metrics like, well, what's the market, what's the product, and then say, is Taco Bell properly valued, or does the market undervalue it? Are most people who invest not thinking about the fact that Mexican food as a business is going to expand, say, in the US? So let's break down some facets of fundamental investing. And there is a lot more to cover here. I did literally write a book about this stuff. What I will do is I'm going to put a document, I'm going to link a document in the description that has a much longer and more complete overview of fundamental analysis. Just think of this as a brief, right? We can start with just your very basic metrics about a company, right? With those being their revenue, their profit, right? And then their expenses. We can also think of expenses as costs. And now the better way, the more realistic way to think of expenses or costs, or in addition to that, right, is assets and liabilities. And this is just sort of the financial view of the fundamentals that drive certain companies and stocks, right? Revenue is just the amount of money that a company makes. Profit is the revenue minus their costs, so how much they're taking home after they pay all the bills they need to pay. Expenses is what they owe or what things cost, and then your assets are what they own, and liabilities are what they owe, right? So generally, the more profit you're making, the better. The more revenue, the better. You want costs to be as low as possible, and then the more assets versus liabilities that you own, the better, right? So, having $1 billion as assets and great. Having $1 billion in assets is great, but if you owe, say, $2 billion in liabilities, right, the actual difference there infers that you owe more than you have, which is bad. So what really matters too is, well, how much in assets do you have versus the volume of liabilities that you owe. Now let's think about how that translates into some specific fundamental metrics about a stock. First off, right, let's create a little graph here. We're going to put price on this axis, P for price, and then let's just do D for date on this axis, right? And then let's say this stock chart looks like this. This price right here is $100. This price is 60, and this price is also just about $100. We can look at the period, right? And you're going to see this with any stock market website you go to. If you just Google a stock, you're going to see what's called the 52-week range, and that is here. Let me write that out. That is going to be the high versus the low, right, of a stock price. In this case, over the last year, over 52 weeks. And what this does is give you insight into how volatile the stock is. It's a really easy way of looking at that, right? So if we look at this stock chart, we saw the low was right about there, and the high, since these are about equal, this is just a little bit higher, is right about there, right? So the 52-week range is going to be this low price and this high price. So let's say $106, and then the low was that's just about $65. Now what this does is tell us, it gives us a whole lot of information about a stock, right? Let's break that down. We know the highest price the stock has been out over the last year. Now if the current price of a stock is right up where the high is, we know, okay, this stock is hot. It's done really well over the last year because right now the price is the highest it's been over the last 52 weeks, over the last year. Meanwhile, if the stock is near the low, right, if the 52-week range is $65 and its its open price or its strike price is $72, well, that infers, hey, the stock isn't doing so well. It's right near its low. And that can mean different things to different people. If you are fundamentally investing because you think the stock is undervalued, because you think it's under its true price, then maybe you want it to be at $65. Maybe you want it to be near its low because that means there's a lot of room to grow, right? And you may think, hey, you're investing right here, and then over time it will go up. In other cases, a stock has done really well, and maybe you think it's going to do even better. So the fact that it's near its highs doesn't mean anything to you. And if it was near its low, right, that would infer something bad. That would mean, hey, look, people don't think this is going to do well. I was really only here because other people are investing, and maybe I shouldn't invest because of that, right? So these mean different things, but what you need to consider, right, is just the information that it does provide you. Now, this also is an insight into the risk or the volatility, because generally a higher trading range, a higher 52-week range means that the stock is more volatile. This company is more likely to go up or down and have big swings. So let's think about two 52-week ranges to illustrate that. One 52-week range is $8 to $10, right? Another 52-week range is 80 cents to $120. And then let's say in this case, dropped my pen. The other case, the current price is $80, right? And then here it is $9.80. So we have two cases, right? The trading range here, 80 cents and $120. That means over the last year, at some point, the stock was as low as 80 cents, and at some point it was as high as $120. And then we know the current price is $80. And then we have this 52-week range, right, in which case the low over the last year was $8, and then the high at some point over the last year was $10, and the current price is $9.80. Well, let's think about what kind of information this gives us about these two stocks. This stock traded within a very narrow range, right? It was at $8. $8 was its absolute low. $10 was its absolute high. That means it only varied by 20% over the course of a year. And then right now, it's very near its high. And what that infers is that there's some element of stable growth, right? Because this, let's say it started out at $8 here, and then it's at $10 here. It's unlikely over that 20% to have done anything like that, right? It's much more likely to have been this sort of stable upward curve. So this is a less volatile and a less risky investment. Meanwhile, this stock started out at 80 cents, or maybe you started out at $60, whatever it started out as, it hit as low as 80 cents per share, and then now it's at $80 a share, and it used to be at some point over the last year at $120 a share, right? That chart could look something like this, right? That's just an incredible just maze of risk, essentially, because if it, if a stock acted a certain way over the last year, you can be fairly confident it's going to act that way over the next year, not in terms of it going up or down, but in terms of the spread or the risk, right? So a stock that is as volatile as this one, say that traded within a range of 80 cents and over $100, it may be less volatile the next year, but it won't be that less volatile, right? It's not going to instantly transform from a chart that looks like this into a chart that looks like this. And maybe that's good for you, right? Maybe you want the risk and you see it at $80 and you think, hey, it's going back to 120. It really just does depend on what you want, and what's critical is the information that we can get from looking at something like, in this case, the 52-week range, right? And that's just one of those fundamental metrics that we're looking at. Now I want to introduce a few specific metrics, a few ratios, right, that also give you a lot of this information and insight into a company. Our first one is going to be EPS, right? EPS stands for earnings per share. Let me outline that. And that is just how much money does a company make per share. And that, here, I'll make this a little bit larger. What that ratio breaks down into is profit divided by shares, right? So what this does is give you an insight into the profitability of a company, into how much money that company makes compared to its value. Now this gives us a window into, I talked earlier about true value, into whether a stock is overvalued or whether it's undervalued, right? And we can think of that theoretical true price, like, hey, this stock is properly valued. We can think of the price as either being below that, so undervalued, or overvalued. Now, if a company has a very, very high value but makes very little money, it's more likely to be overvalued. Meanwhile, if a company makes a whole lot of money, they make $1 billion, but the company or the market only says that the market cap or the value of the company is $100 million, right? Then it's probably undervalued. And these are not rules, right? Just general trends. So let's think about, as an example, a company that makes, they do $1 billion a year in revenue, and they have $600 million a year in costs, right? And then their market cap, let's say, is $500 million. And then their market cap is 500 million, right? So let's organize this a little bit better. What this tells us, right, off the bat, $500 million market cap, $1 billion in revenue, and $600 million in costs, is that the profit, right, is the difference between revenue and cost. So they made $1 billion, they spent $600 million. That means their profit is going to be $400 million. And then we know the market cap is $500 million. And then let's say they have 100 million shares, right? So if they have $500 million, that's the value of their company, their publicly traded shares, and then they have 100 million shares on the market, then that means the value per share, the price per share is $5, right? 500 million divided by a million. So we have $400 million in profit, right? And then we have $5 per share for our 100 million shares. Well, to think about earnings per share, right, which gives us an insight into the value of the company, we just need to divide this $400 million in profit by this 100 million shares, right? So we have 400 million divided by 100 million. Let's write this out. We have, to simplify it, 400 divided by 100 is 4, or in this case, 400 million divided by 100 million is still going to be 4. So what that means is the earnings per share is $4, right? And this should be intuitive. All this is saying is that you're going to make $4, or the company makes $4 in profit for every share that's on the market. Alone, that doesn't mean anything. That doesn't mean much, right? Although it does tell you if it's profitable, right? So if this is a positive number, then you know that the company is making money, that it is profitable. And then if that is a negative number, you know, hey, the company is losing money, because for every share on the market, if that's negative 3 cents, right? If it's negative $1, they're losing a certain amount of money. So that really is just, and this in this case, that just tells us this company, for every share on the market, makes about $4. And what is, again, less important is just this $4, and more so, did this go from $3 last year to $4 now, or did it go from $5 last year to $4 now, right? If we think or if we look at earnings per share over time, that gives us an idea of compared to the value of this company, compared to the market cap of it, right? Is it doing better now, or is it doing not as well now, right? So in this case, you may have some standout quarters, like this one, say, did really well this quarter in terms of earnings per share, but this overall trend line is positive. That generally means compared to the value of the company, they're making more money, right? And that's generally a good thing. Meanwhile, again, to the inverse, if a company is making less money per share, well, that's bad. That means they're less efficient, right? And you know, an example of this is, say, Tesla versus Coca-Cola, right? Tesla, when they just started out, they were burning a whole lot of cash, they were spending a lot of money, but they had an extraordinarily high market cap, right? So in this case of Tesla, let's theoretically say they have a $600 billion market cap, they have 100 million shares on the market, and they're losing $1 billion a year. Well, their earnings per share is going to be negative $10, as in for each share on the market, for each of those 100 million shares, they're losing on average $10, right? Because this formula of profit over shares is just $1 billion over 100 million, except now this number is negative. So in that way, this tells us a lot about Tesla. This says, okay, hey, they're burning a lot of cash, but a lot of people believe in them. A lot of people think the company is going to do better because this is so high, because they have a $600 billion market cap, even though they're losing money. Meanwhile, in the case of, say, Coca-Cola, or a company that's been around for a while, they may have a $200 billion market cap and do, $100 billion a year in revenue, right? Let's say $50 billion a year in profit. And in that case, they're making a lot more money, a lot more profit per share. Now, another metric that is similar to your earnings per share is your P to E ratios, your P to E ratio. And you're going to see a lot of P over various numbers like price to sales and so on. I just want to right now focus on P to E. What P to E means is price to earnings, right? And this compares the price of the stock to their EPS, to their earnings per share, right? So earnings in this case just means EPS. And this gives us an idea of the multiple of the stock price compared to the amount of money they're making, which sounds confusing, but all that's saying is if your P to E ratio is higher, right, then you're making less and worth more, whereas the lower your price to earnings ratio is, the more you make and the less you're worth. So for example, right, let's say the stock price is $100 and their EPS is $2, right? Your P to E ratio is going to be 100 divided by 2, or 50, right? So a 50x ratio, or a 50x multiple, because the multiple of your price compared to earnings is 50, as in 100 is 50 times more than 2. If you have a 50x price to earnings ratio, right, and your competitor has a 10x, well, what does that mean? That means compared to your competitor, you are making less and worth more, as in the price per share is higher even though you're less profitable, even though you're making less money. Now again, you have to consider things like price to earnings ratio in context, because some industries are known for higher price to earnings ratio and higher P to Es and so on, while other industries are known for being more conservative. So there's a few different lenses to consider price to earnings, right? One is, objectively, what's the number at? Is it 150x or is it 2x, right? Another is compared to peers, and this really is critical. And what this says is compared to similar companies, is this overvalued or is this undervalued? So let's say we have Coca-Cola. We have Coca-Cola, and then we have Red Bull, and then we have Starbucks, right? Very different businesses, but let's just say generically they're all in that beverage niche, right? Coca-Cola sells Coca-Cola and a whole host of other beverages. Red Bull is in the energy drink space, and Starbucks is in the coffee space. Now let's say Coca-Cola, right, their P to E ratio is 2x. So they may be, their earnings per share might be $8, and the price of the stock is $16, right? So there's a 2x multiple there. Red Bull, right? Red Bull is at an 8x. So say they make $4 a share and the price per share is $32, right? So P to E is 8. And then Starbucks is right in the middle. They're at a 4x, right? This gives us a lot of information about any one of these stocks compared to its peers, right? Let's take Red Bull as an example. Their price to earnings is higher, right? That means people believe in them. They're more willing to invest in Red Bull despite the fact the competitors are making more money, right? As in Red Bull is worth more despite making less. And if it's worth more despite making less, there's probably a reason for that, right? Maybe people think Red Bull is going to grow faster, or they're making a strategic acquisition and they're going to grow they're going to do a lot more in revenue next year. So people think, hey, this is 8x now, but it's going to go to 4x because it's going to grow so fast, and then it'll be in line with these other guys, right? Whereas Coca-Cola is more, established. It's more conservative. It's not going to do anything crazy, but hey, they're making good money. They're making a 2x, so maybe you can buy them for that reason. So in that case, you can compare to peers. You can objectively just look at, hey, is this undervalued or overvalued? And then perhaps most critically, you can look at EPS or earnings, or excuse me, or EPS, we're on price to earnings. You can look at the P/E ratio over time. And all this says, and this is within the scope of a single company. So, let's get some more space here. Let's say we are considering investing in iRobot, right? And iRobot makes things like Roombas, so basically hardware devices that say clean your house. And the earnings per share the price to earnings ratio of Roomba or iRobot is this. What this says, and this can mean different things, but let's say this is the P/E ratio. The P/E ratio is strongly trending down. And considering the price to earnings only weighs two factors, either earnings per share or the price of the stock, this can only mean one of a few things, right? One is that the price went down, right? Because if earnings per share stays the same and the price goes down, well, the multiple collapses, right? 100 to 2 goes to, say, 50 to 2, and that's 25 versus 50x. So the price went down, or the earnings per share went up, right? Which just means really they made more profit, or that's likely the case, or some combination of these two things, right? This gives us a lot of insight into the company, because off the top of our heads, if we looked at a chart of theirs, right, and let's say the price didn't actually decrease, right? The price was stable over the last year, but your P/E ratio really went down. Well, hey, that means they made a lot more money. They made a lot more profit. And if they made a lot more profit, that's really good in the case of the stock, right? Because that means they did something internally. They cut costs. They had a new product. Now they're making more money. Meanwhile, the inverse could be true as well, right? Perhaps actually they didn't get more profitable, but they said, hey, next year we're going to come out with a really good product. And for that reason, the price went up, right? And so the P/E ratio went up as well. So that's just one of those fundamental metrics that really a lot of people look at. And that also gives you a lot of information about a stock just through the lens of that one number. Now, we talked about dividends earlier. Just to touch on that again, if you see here, let's go back to iRobot. If you see iRobot and you see the dividend yield being, say, 2%, that means for every share of the stock that you own, they're going to give you 2% of that per year in cash, right? Or just 2% of whatever dollar amount you invest. Now that people can buy fractional shares, which just means instead of buying 1 or 2 or 3 shares, now you can buy half a share, right? So if the stock is at $100 and the dividend yield is 2%, then you're going to get $2 a year per share of the $100 stock you own. If you invest, say, $533, then you're going to get $10.60 for owning it, right? Just 2% of the amount that you invest. You can also look at the next earnings date. You're going to see this on or near the chart of a stock. Next earnings date is just when those quarters are hitting, right? We have Q1, Q2, Q3, Q4. If we're right here, if we're in, say, November, and then December is coming up and they have their quarterly report for Q3 coming out in, say, late December, right? Earnings date just tells you when they're going to have that report. And that is, again, useful information for all the reasons we went into relating to their quarterly and annual reports as well. I'll also note that generally a lot of companies see very good results in the third or fourth quarter. you see, say, Walmart, Amazon, Target, like your retailers, they're going to sell a lot more because of holidays in that fourth quarter. A lot of companies also have a slow start to the year. They have a slow Q1. This also varies, obviously, as per the company in hand, but generally you are going to see sales pick up throughout the year, with your holiday season being when most companies perform the best in terms of sales, revenue, and so on. So if you see really good Q4 results, well, hey, it's probably not going to be as good for the Q1 or the first few months of the next year. Now that covers some of those core fundamentals of a stock. Now on this note, what we're going to cover next is earnings, right? So, what I said earlier was every few months stocks will have their quarterly reports, and those quarterly reports are called earnings, right? Where they detail basically how much they earned. They're going to go over and they're going to release a few documents that are really important to understand on those earnings calls. There's quarterly reports and also their annual report, which is also an earning call, right? Those are synonymous terms. Now, those few documents are also just generally really important in the business world, right? If you generally want to understand how a company works, how it operates, how it makes money, what they're spending money on, whether they're growing or getting smaller, just their whole, directly their financial situation, but just the whole situation of the company as well, you're going to need to understand these few documents. So let's just briefly cover what those are. And these generally are... this is information relating to earnings, and that this information, these documents will be discussed on an earnings call. The first of those is the income statement. The second is the balance sheet. And the third is the cash flow statement. Now, if you start a business as well, you're going to need all three of these documents. They're extremely useful just when it comes to tracking money in the operations, the financials of your company. And again, these are also, every business, whether they're public or private, that's established will have their income statements, their balance sheets, their cash flow statements, and so on. This just generally is very core, very important knowledge to just wrap your head around. Your income statement covers your revenue, your expenses, and your profit, right? And let's just focus on that for a second. Basically, the income statement is how much money you made, how much money you spent, and the difference, right? So the take-home amount of money there. And, in economics, and I touched on this briefly, but we have profit, right? We have PR is equivalent to revenue, and in economics, that's called total revenue, or just overall the amount of money you brought in minus your total costs, right? So profit is revenue minus costs. And then this all breaks down, right? Total revenue breaks down very simply into the quantity of goods sold times the price, right? So if we sold 100 units of our product for $100, right, then our total revenue is going to be just $10,000. And then total costs is going to break down into, and here I'll come over here, that's going to break down into costs multiplied by quantity, right? So your cost per unit times the amount of goods sold. This does vary as per sort of fixed and variable costs. If you know what I'm talking about, you know what I'm talking about. If not, don't worry about it. But generally, your income statement is going to break down all of these things. It's going to say, okay, this is the overall amount of money this company made, right? Based on the number of units they sold and the price they sold each unit for. And then it's going to break down where that money went, so what they spent it on, right? Did they take on debt? Did they spend it on creating, right, the products if they're a manufacturer? Just overall, right, where did that money go? So it's going to cover those revenues, those expenses, and then just the difference. So the total revenue, which is right here, minus those total costs. That's just the first. Then we're going to get on to the balance sheet, right? Income statement, is very much the active nature of the business. It's, oh, right now, how much money are we making? How many units are we selling? And so on. The balance sheet is a very similar document, but very different in that it covers primarily your assets and liabilities. Right, and again, this is not the same as income. This is not the same as the amount of money you make. Here, I'll write this out. This is what you own and what you owe. So let's make that very clear. Own and owe. So if you want to see how much debt a company has, right, who they owe money to, the amount of real estate, the amount of product, right, the amount of the value of the tangible assets and intangible assets of a company, right, all you need to do is look at the balance sheet. This is very useful information. And to recap once more, an asset is just something that you own, a liability is something that you owe, right, to someone else. So if a company has $1 billion that they owe to a bank, if they owe investors money, right, if they owe their own customers or partners or suppliers money, right, those are all going to be under liabilities. Meanwhile, the amount of equipment that they own, if they own, say, company vehicles, the real estate, so the company office, the IP, right, the patents, the trademarks that they own, those are all going to be under assets. Now, objectively, right, this is useful information. Like, if we know that a company has $100 million in assets and $200 million in liabilities, that's bad. That means that they owe a lot more than they have. And generally, you want to see more assets and fewer liabilities. But also what matters is the ratio, right? Not just, hey, they have 100 million here and they have 200 million there, but how much more of one versus the other do they have? So if you have $1 billion of liabilities, that can be scary if you have only $500 million in assets. But if you have $2 billion in assets, well, that's a lot better than having than owing more than you own. You also want to look at these things over time, not just in comparison to each other. So if your liabilities are, say, trending upward, and your assets are trending upward, and your liabilities are trending downward, well, that's good. Even if you have, say, 100 million assets and 100 million in liabilities, if your liabilities decreased by 100 million last year and your assets increased by 100 million, right? Well, that's better than the opposite. That's pretty good in terms of where these trends are going. What also matters is the type of the assets and the liabilities that they have, right? If a company has $300 million in short-term obligations or short-term debt, that means that they're going to need to pay someone back to the tune of $300 million very, very soon, right? And to do that, they need $300 million in assets, right? So that's very different from the type of liability in that maybe they owe someone money, but it's at a 1% interest rate and they have 20 years to pay it back, right? So the type of debt, the type of, hey, how much do I owe you, but when do I pay it back, and how much do I need to pay you back? And then also the type of assets is important. If a company owns a lot of real estate, right, let's say you're WeWork, maybe you have a lot of assets now, but if you, as an investor, think the housing market is going to do poorly, well, maybe you can predict, okay, the amount of assets they have will decrease because they own all this real estate that's not going to go anywhere over the next few years. So just like earnings per share and price to earnings, right, your P/E ratios, all of this matters in context. It's not just the number, it's where did the number used to be and where is the number going. Now the third statement here is the cash flow statement. This one is easier to understand in that it is exactly how it sounds, right? Let me write out. Cash flow statement describes how cash flows through a company, right? So you're going to make money in some way, you're going to make a certain amount of cash, and then things are going to be done with it, right? It's going to be spent on, say, paying your employees and investing in R&D and getting a new office, right, or expanding your production line. And then that cash that cash leaves, right, in a certain way. Like, hey, you spent it on your own employees, you spent it on debt or liabilities. So the cash flow statement versus these other two these other two sheets gives you an idea of how the money moves internally, right? Assets and liabilities is just how much you own and how much you owe. And then your revenue, your profit, your expenses is very much just on the outside. Okay, we made this much money, we spent this much money, and this was the difference. Cash flow statement is hey, what are we actually spending this money on, right? What did we invest in to make more revenue this year? Or why did our expenses go up, right? What do we spend the cash on, or what got more expensive, right? For our expenses to go up and then our profit to go down. So in that way, the cash flow statement is a very useful tool to understand not just these numbers of, okay, profit went up and liabilities went down, but what's actually being done with the cash, right, to go and do things and to produce these outputs like, okay, the stock price is going up because earnings per share went up, and then the value, say, of their IP went up or something of that sort. Now, those are the three main documents that are detailed on an earnings, a quarterly earnings call or report, right? Your income statement, your balance sheet, and your cash flow statement. You're going to see one more part or a few more parts at the end of those calls. And you can always join these companies' earnings calls. They're always live and recorded. In fact, companies are required to make sure their investors can access those quarterly calls. But you're also going to see a Q&A, right? And then you're going to see predictions. And these are two very useful parts of an earnings call to pay attention to and to listen to, and they do move the price of stocks. And the reason that happens is because, if one thing is being clear, hopefully over the last 30 minutes, is that once again, these things matter in context. It's not just how much money you make, but it's how you make it. It's whether you're going to make more, whether that's going to go up or down or so on. Q&A and predictions are kind of where the company can put they can give you an idea of what they're thinking about all of the context for all of their financials and the fundamentals about their company, right? So a Q&A is exactly that. It's an opportunity for your professional analysts and your just standard, say, shareholders, like someone who owns, say, 100 shares of NVIDIA, right? To ask the senior executives and the board members and so on about the company. Right, if a company has been avoiding some sort of scandal for 3 months, right, this is when the CEO, right, has to answer a question about that. And if the CEO dodges that question, well, maybe the stock will go down, right? So in that way, it's a very good public square where you can get insights into what is the CEO actually thinking, what are all these executives feeling, and what are they thinking about based on the hard questions that are asked to them by analysts and shareholders or stakeholders. Now, Q&A is them asking or answering questions, right? Predictions is a statement they'll make or a talk they'll give about where they think their own company is going. So as the CEO of a company, right, you really need to know or you're in the best position to know how your company is going to do, right? If you think you're going to sell more say if you're good next year, right? Or you think that there's going to be less demand, so you're going to sell less, or costs are going up, so you're going to make less profit even if you sell more units, right? All of those are forecasts and really do move stocks. So if a CEO of a company comes out and says, hey, we're going to make less money next year, right? The price of a stock will nearly always go down. Meanwhile, if a company says, hey, we're going to make a lot more money next year, we're going to do really well, right? Then obviously the stock is going to go up. People are going to take that as a good sign. And what matters is not just their predictions, but it's how their predictions lined up with analysts' predictions, right? So your stock analysts are going to go out there and say, hey, we think this company is going to make $2.3 million in profit this quarter. If they come out and say, okay, we made $2.4 million this quarter, and that's great. We beat analysts' expectations, but we're only going to make $1.8 million next quarter. And analysts said, oh, hey, they're going to make $2 million next quarter. Then the stock could go down, right? So predictions matter in context. You could do better next year, But if you do less good than the analysts think you should do, or if you do worse than competitors, then you can still, your stock price can still go down. But in that way, this really, again, is the public square. It's the way for the executives of a company to share with the public and with their investors and analysts about how they think the company is going to do, and to respond to some of those common questions that investors have, whether that's about new products, whether it's about, again, a scandal, or just generally say how they think certain challenges may impact the company or opportunities. So that largely covers some of the ways in which we can understand, we can get information about a stock, whether that's reading their balance sheet, whether it's looking at the industry or the sector that they work in, or that's reading through and listening to the Q&A provided by a company at their earnings call. Now what we're going to do is we're going to get into the strategy and tips and recommendations I have when it comes to actually investing, right? So the strategy of it. Now, immediately after this, we're going to get into, the next steps you can take right now to go and open an account and make your first investment. This is just going to be, okay, hey, you decide you want to start investing. You now know how to pick good stocks. Well, how do I go and how should I act if a stock goes up or goes down? Or what rules, what guidelines, what habits should I have that will make me a better investor? And the first point I want to make clear is you absolutely should have a strategy. And that depends upon a few things, right? Number one is, what do you want to get out of investing? I think number two is, how old are you and how much money can you put into investing? And then C, what's your risk profile, right? Are you looking to take on a lot of risk and make a lot of money, or do you want something more stable? And all of those things just depend upon you and the context of your life and what you want and the kind of investor you are. Some people prefer the really exciting stocks, right? The oil stocks, the growth stocks, the startups of the world that go up and down and up and down. Other people just want to put their money in and never think about it again. And both of those are great. It just comes down to what is best for you as an investor. And if you're 20 years old, right, you have 40 years, you have a long time to invest. For that reason, you can afford to take on some more risk, right? Because on average, risk may make you more money, even if there's some losses on the way. But if you have 20 years, if you have 40 years throughout which you're investing, you can take the little down here and the little down here as long as overall things are going up. Meanwhile, again, if you just want to make some money, because in 5 years you're going to retire and you have a bunch of money sitting in cash right now, maybe you just want to put that in the S&P 500, or you want to put it in an index, right, a mutual fund where there's less risk, but you're also going to, on average, make less money. But approaching it with a strategy, starting to invest, thinking, hey, I want to invest for the next 40 years. I want to invest just in mutual funds or just in stocks, or I want to learn about options, right? Approaching it with that mindset of, okay, here's what I'm doing, here's the plan, and I'm going to stick to that plan. That is the much better way to do it. The reason for that is because money is inherently a very emotional thing, right? We all care about money. We all put a lot of effort into money, and it matters. It's an important thing at the end of the day, right? And if people hate one thing, right, it is losing money. People will do crazy things to make money. They will do even crazier things to not lose it, right? And that's why approaching investing with a plan is the best way to go about it before you experience that emotion of investing, right? Because if you put $1,000 in a growth stock tomorrow and it goes down by 8% in the next month, you just lost $80. You're probably going to feel really bad about that. Now, a lot of people, right, let's say you buy a stock here, right? It's been going up, it's been doing consistently very well, and then again, boom, it goes down, you just lost your $80. A lot of people are going to sell here, right? They're going to be like, okay, hey, it was doing well, now it's not doing well. In the last month, it didn't do as well. I'm going to sell, I'm going to just save what money I do have. Right? When really all this is, oh, it had a big run up here, made a lot of money, did really well. Now it's taking a little down, and then it's going to continue to do this. It's going to do well over the long run, even if you have this little period of it going down. And that's why emotion is just the antithesis of investing, right? Those are contrary things. You either invest and you do it in a smart way, you do it rationally, or you go in with this emotional mindset. And if you do it with emotion, you're going to lose money and you're just going to be a lot worse off in terms of how you feel about it, right? You're going to be anxious, you're going to be stressed. The much better way to do it is just invest for the long run, and then just don't check your accounts unless you really want to, right? Just invest in the S&P every week, or pick a few stocks or companies that you believe in, right? And just let that money run for the next 10, 20, 30 years. If you do it that way, you don't have to care about this. This doesn't matter, right? Because net, right, the overall return that you're making is this whole positive trend line over here. And long-term investing really does win. There's, right, in the United States, there is the S&P 500 index. That is this very popular index that's the top 500 stocks in the U.S. economy. If you look at the S&P chart, there were some big bumps along the way, right? It looks more so like this than a straight line. But overall, over the last, say, 80, 100 years, it's done extraordinarily well. It's produced over a 10% return per year. However, and here's the interesting thing. If you took your money out of the market for just 2 or 3 of the highest performing years of the S&P, so this year right there, maybe let's say there was a bump there, right? And so on, you'd miss out on most of the returns. Not some of the returns, most of the returns. And that means if you were constantly buying in and buying out of the market, or something like the S&P, which really just represents most stocks, like a general index, a general bucket of stocks, then you're going to do worse on average than someone who just bought and held. And that is the strange phenomenon of investing, right? Most people who constantly buy and sell, who are getting in there and they're selling there and they're buying again here, and they bought there and they really bought here, right, and so on. Those people usually, nearly always, do worse than someone who just bought right there and just held throughout this entire period. And they didn't have to think about their investment, right? They just check it every few years, because if you invest in the S&P, you're investing in the U.S. economy. If you generally think the U.S. economy is going to do well, then who cares how it does this year or next year, right? You just care how it does over 10, 20, 30 years. So again, this depends upon you, right? If you want to retire in 5 years, it may be a different story. You may want to take on less risk. But generally, investing for the long term and just holding, right, stocks and companies and mutual funds that you believe in, that is what's going to make you money versus getting in now, getting out next month, and so on. And that's why investing as well is so important, right? The reason this logic holds, right, the logic of buying and not selling for a long time, is because you have less risk, right? You're going to make just as much money, but you're going to do it without losing as much money. Whereas a day trader may make the same amount of money or even less money than you by trading all the time versus you just buying and selling. But they have to put a lot of effort in. They take on more risk. It's generally worse off, right? The diversification is valuable for very similar reasons, right? And you hear this all the time. Just don't put all your eggs in one basket. That just works for the same reason that mutual funds and index funds work, and the same reason you should buy and hold over a long period of time. Is just you take on less risk if you spread out your assets and if you hold them throughout good times and bad times, right? So as opposed to investing in one stock and holding that stock for a year, right, you can invest in 100 stocks and hold them for 5 years. Diversifying, whether it's the type of industry you invest in, whether it's the country you invest in, whether it's the dividend and income stock versus a blue chip or a growth stock or a biotech or a startup, right? Diversifying across those different types of stocks it will, on average, bring you closer to the overall trend line, right? And this is kind of the phenomenon of crowd psychology as well when it comes to guessing, right? with that story being, there's a certain number of jelly beans, right, in a jar. And let's say there are 600 jelly beans in this jar, right? If you ask one person how many jelly beans they think are in the jar, they may say 400, someone else may say 2,000, someone may say 50, right? These people are all very, very off, right? But if you ask enough people how many jelly beans are in this jar, what you see happen is that their guesses come together, and on average, they're much closer to being correct. And the same is happening here when you diversify. When you diversify, when you invest for long periods of time, your returns go from being 8% one year and negative 2% the next year and 3% this year to, okay, now I'm making 3, 4, 8, 12% a year, whatever that number is. And for that reason, just diversifying your investments within the stock market, in addition to as a whole, as in you don't want all your money in the stock market versus, say, real estate, debt, not debt, but debt instruments, right, like bonds and gold and crypto and so on. These are all different types of assets that you can hold your money so that on average you're going to make money versus experiencing the highs and then experiencing the lows as well. Now I want to make one quick note here that really it does impact some people more than others when they start investing, and that is just prices don't matter, right? Price is really irrelevant. And by that I mean, if you see a stock that costs $10,000 a share and a stock that costs $100 a share, right? The stock that costs $10,000 a share is not necessarily 10 times or 100 times more valuable than the stock worth $100 a share. What really matters in terms of size is market cap, right? Price can be set. Price is totally arbitrary, right? And the reason for that is because the number of shares can be set and exchanged by companies, right? So if I have a stock that's at $10,000 now, and I have 1,000 shares of this $10,000 stock, well, I can arbitrarily, and companies do this all the time, and it's called splitting your stock. I can make this 10,000 shares, right? And then boom, the price goes from $10,000 a share to $1,000 a share. And then even I could go from 10,000 to 1 million shares because I want, say, my stock to look cheaper. And then, I guess this is off the screen here, but the amount of shares or the price per share is going to go to $10, right? And a company that has a $10,000 price per share, or their stock is priced at $10,000, and they have 1,000 shares out there, is exactly the same in terms of its value, its market cap, as a company with 1 million shares, where the price per share is $10. So, and companies do this all the time. Again, in that psychology does matter in the stock market, but it shouldn't, right? And if companies feel that their share price is getting too high, they will purposely make it lower. And if a company can just choose one day to make their stock price lower, right, that really shouldn't impact how you invest. So prices don't matter. And what you do see now as well is fractional investing, where you can buy 1% of a stock, right? Like if you have, right now, if you open an account and you have $18 to invest, right, you can go buy $1,000 stock. It's just you're buying, say, 1.8% of that $1,000 stock. But you can't do that nowadays. You don't need $1,000 to go buy a share of the stock that is a whole numeral, like one share, 10 shares. You can buy your 0.018 shares. So price is completely irrelevant, and I really urge you, just because the stock is cheap or just because it's expensive does not mean with all other factors at a constant that you should or you should not buy it. That just should not weigh in your investment decision. Now I want to go over 2 final suggestions here when it comes to how you should trade. These are somewhat related, and the first one is going to be trade what you know, and then the second one is understand the economy, right? Trade what you know and understand the economy. And over the past few hours, I've spoken a lot about the context for a stock, right? Things like the industry it's in, means that it's probably going to behave in a certain way. And the size of the company means it's going to behave in a certain way generally, not always, but most of the time. The driving factor for a lot of companies, right, and not just your cyclical stocks, but nearly all stocks, is the macroeconomic situation, or the economy of the country, the economy of the world, and so on. And you saw this during COVID, right? During COVID, the whole world, right? I'm going to very badly draw a world here. The whole world had a macroeconomic problem, as in shipping was down. There was, everyone's not buying things. They're inside, and so because of that, stock markets, if this is just a generalized index of the stock market, basically did this, and they recovered for the most part. But there was this big spike here, or this big decline. And if you just look at the balance sheet of a company, right, or you think it's undervalued and you buy it, right, you're not accounting for big declines like this that don't happen because of the company. They happen because of the world or the country. They happen because of the economy, right? So in that way, understanding the economy of the country you're investing in and keeping up to date with the world economy as well is really important when it comes to investing in stocks, right? So if you live in India or Cambodia, right, you really need to know what's going on and what the government is doing, what the biggest companies in those countries are doing, because those are going to impact the stocks and the companies you invest in, right? That's one side of it, right? That's understanding the context or the situation that the companies that you're investing in are operating in. The flip side of that, and I think this is just as valuable, is to trade what you know. In that, generally, right, there's a lot of very smart people out there who are investing. There's a lot of analysts who do this professionally. More so than that, there are computers, right, that have algorithms that just do most of the trading nowadays, right? Like literally over 50% of trades that are done in the stock market today are done by a computer, which means how are you going to beat the market, right? How are you not going to lose money? How are you going to make more money? How are you going to beat the market on average? The way to do that is not by being smarter, right? It's not by having a better algorithm for the vast majority of people if you're not $1 billion hedge fund. The way to do it is trading what you know. It's investing in products and services that you believe are going to win because you have unique experience with them, right? So for a lot of people, that's investing in the industry that they work in. So say you work as a secretary, right, in a private equity firm, and your private equity firm buys a juice company that uses a new fruit or a new vegetable in their beverages, right, in their juices, and you're like, hey, this is the next big thing, this is going to do really well. Well, hey, just buy the stock of that company when it goes public in 6 months, or buy a similar company, because you know this, you have experience with this, when nearly everyone hasn't heard of this, when most analysts have never heard of this company, most people generally, right? So in this way, you can beat the market by just investing in the things you have experience in. And it's the same if you go to your grocery store and you try a new product. If you go and buy shoes and you say, hey, these were really great shoes, or you go to a new doctor, a new type of doctor's office, say like one of the new virtual ones. If you have really good experiences with those products and services, hey, maybe just do some research on those specific stocks, because in that way, you are now betting on something on your experience of, hey, I as a customer had a great either I really enjoyed this product or service, it was better than competitors, whatever the experience was, you experienced that uniquely. And not because of public information, not because of something you can Google or because of a pattern in a chart, but rather because of the experiences that you have had as an individual. So in that way, by trading what you know, you can do really well, especially over the long run, right? And that doesn't mean if you buy a Tesla and you think the cars are great, so you buy some Tesla stock, that it's going to do well over the next year. But that means if you believe in electric vehicles and you understand electric vehicles and you think the market is going to do well over the next 20 years, right, then maybe that is an investment that is going to do well. And that's what you have seen from Tesla, from Rivian initially, from a lot of these electric vehicle makers. And as one more just final note here, there's a rule that Jim Cramer, who is a very popular investor in some circles at least, or a spokesperson on the subject, that's no woulda, no shoulda, no coulda. And what that refers to is the emotional impact of investing, where this is a game of money. You're going to make money on some days, you're going to lose money on some days. And over time, you're going to make money. But it's not going to feel good in this period, right? Where you're not making as much money. It's not going to feel good in this period when you're losing money. So what he says is, there's no I would have done this, there's no I should have done this, and there's no I could have done this in terms of how you should react when you lose money. And this just means if you make an investment that doesn't go well and you lose half of your money and you decide, hey, this is just going to get worse, so I have to sell, not because of the emotion, but because of the rational your analysis of the situation, where you say, hey, okay, something fundamentally changed in the company, so now I should sell even though I lost money. What you shouldn't do in those situations is, oh, I should have done this the next day, and oh, if I could do it over again, I would have done it this way. The way to deal with those is just, okay, hey, here's the lesson I took away. Here's how I'm going to change my investing behavior because of that lesson, right? And then let me go and put that into action. You are going to be much better off that way than the perspective of, oh my God, this is the end of the world, and I really messed up, and I'm just trying to daydream about how you can fix that or how you would have done it differently. You will have those moments, but if you just, again, invest over the long run, then those individual losses don't matter as much. It's really just over the next 10 years, am I going to make money, and not, hey, I lost $100, I lost $1,000 this week. So those largely cover my perspective on your tips and rules and habits and strategies when it comes to investing. Again, generally it's just about who you are, what you want out of investing, and then just investing over the long run in companies that you believe in. That generally will get you most of the way there. What I want to briefly touch on now, as I've been alluding to throughout the entirety of this video, is actually making your first investment. What I want to stress is that, as I've been saying, you want to invest, over the long run. You want to invest consistently, and any amount of money you can invest will leave you far better off, right? And this somewhat varies, and there are exceptions to this, and I went over this in another video, and that's my bad financial advice video. Whereas I don't think you should always, if you don't make much money, invest without at least considering how to make more money. But if you invest, especially when you're young, especially if you have a solid income, the sooner you can do it and the more you can do, the better. What that means is investing $100 a month may not sound like a lot, right? But that really will add up. That's great, right? If you can invest $100, great. If it's $1,000 a month that you can invest, fantastic. If it's $10 a month, right? Maybe that $10 won't change your life, but you can get experience from that investing. You can learn what makes companies do well and what makes them do worse. That $10 isn't going to make you rich at all, but if you focus on making more money, right, on getting to the point where you can invest $1,000 a month while you get the experience of investing with $10 a month, then that's a win in my book. So then when it comes to actually making those investments, right, I've used the word brokerages a few times throughout this video. Brokerages are companies that let you invest in stocks and other assets, right? So what you want to do is create a brokerage account. A brokerage account is just an account that lets you buy stocks, buy mutual funds, index funds, and so on. And you can think of this as a bank account, right? You have a bank account, probably a checking account or a saving account right now that lets you just hold money and say have a debit or a credit card. This is exactly the same. It's just a bank account for stocks. And for many of these, right, you can use those accounts as a checking or as a savings account. And also for a lot of 401ks and Roth IRAs and so on, you can invest in assets and stocks and into the stock market directly from those accounts. So hopefully you have experience in those ways. But if you don't, you can just go to any big brokerage provider and you can invest in those assets, right? There's Fidelity, Vanguard, E-Trade, Charles Schwab, etc. There's a lot of big, great options out there. And you can either Google just best brokerage accounts to open. I'm going to put a few up on the screen right now. The ones I personally use are E-Trade, Fidelity, and primarily Charles Schwab. So Fidelity I used to use for options and some trading of that sort, which again I don't recommend initially. Charles Schwab is a great all-around option. And then E-Trade, which got purchased by Morgan Stanley, which is another brokerage bank and firm as well, is similar to those other tools and to Charles Schwab. So largely, they're all the same. Like Fidelity isn't that different from E-Trade, which isn't that different from Charles Schwab. What you just want to do is go create an account there, and then you can start investing directly from those by just hooking up a bank account. I really do hope you start investing because of this video. If you haven't, or at least you've learned more about investing in the stock market, because again, in terms of wealth generation over the past century, there's been real estate and there's been the stock market, and that's largely been it. And in terms of real estate, right? People make money. Millionaires are created in real estate. Like you'll see the popular stats out there, because the value of their home goes up. But that is a very passive form of investing. That's just, I want to buy a house for the house, right? So I can live somewhere, and then you make money in that way. The stock market can still be passive. You don't have to day trade. You can just say buy the Dow Jones index, right, or the QQQ index, say once a week or once a month. But it is you choosing to invest your money. And the amount of people that have made an incredible amount of money that way and who have really gotten to that point of financial freedom, or at least accelerated their journey to financial freedom through investing in stocks, is just enormous over the past, century, and really as long as these markets have been around. So if you haven't invested, hopefully this is your sign to do so. With that said, I'm going to put resources up on the screen right now. So these are some stock books that you can read. Here are some stock podcasts, some websites, and then some YouTube channels. With that said, again, thank you for watching. Let me know what you want to see in future videos in the comments, and I will see you in the next one.